Hello all my dear students, I hope you all are doing good. I welcome you all to the next part of our revision video of CA Final Direct Tax Full English. Okay, so let's go ahead with the next part. That is the next chapter, and that is chapter number 16, which is one of the most important topic in the chapter of assessment procedure, and that is income escaping assessment. So what is income escaping assessment? For understanding the concept of income escaping assessment in detail, you need to understand section 47 to section 153 in detail. Okay. Now, the first thing which we need to understand is the basic section, section 147, which says that this assessment also, just like the previous two assessments, regular and best judgment assessment, this assessment will also be done by the AO. Now, AO will do assessment of what? The assessment of escaped income, the income which got escaped earlier. Now, the question is, the income can get escaped because of whom? The income can get escaped because of two reasons. One is because of assessee's default. If the income is getting escaped because of assessee's default, 147 will be attracted. The AO will impose tax on you, will impose interest on you, and will also impose penalty under various provisions which is applicable in your case. Okay. Now, this is the first part. The second part is the income can also get escaped because of subsequent development in law. Subsequent development in law means what? Suppose there is some Supreme Court judgment which came in some other person's case. Suppose in Mr. Y's case, Supreme Court judgment came that this expenditure is disallowed. So now the AO gets power in my case also to disallow that expenditure for earlier year. Or if there is a retrospective amendment which came that this expenditure is disallowed on a retrospective basis from say 2015, it is disallowed. So the AO gets power in that case to disallow all the expenses of all the assessees across the country on a retrospective basis. So because of some other person's judgment or because of retrospective amendment, if your case is getting what? Disallowed, that is known as income escape because of subsequent development in law. But in case of subsequent development in law, the AO can impose tax on you, but he cannot impose penalty and interest on you. So that is a relaxation which is given over here. Now if the AO wants to impose a tax under this section, if he wants to assess the assessee under this section, then he has to follow a procedure which is given under section 148 to 153. If he follows the procedures which are given under 148 to 153, then he can assess such income and also any other income which is subsequently noticed during the course of the proceeding. So he can assess the income which he wants to assess, but if he find out any other income subsequently, he can assess that also during the course of the assessment proceeding. So now our entire focus would be to understand what is 148, 149, 150, 151, 152, 153, because to understand 147, you need to understand these series of sections. So let us understand 148. What is 148? 148 is a notice which you will give, which the AO will give to the assessee to file the return. Now, because before giving this notice also, the AO has to give one more notice to the assessee, which is in the form of a show cause notice under 148A. So let us understand the procedure. 148 is the notice which the AO will give to the assessee so that the assessee can file an ITR under 148 and then the assessment will be done. Now, before issuing this notice also, the AO is obliged, AO is compulsorily supposed to send one more notice to get an inquiry of the assessee done under 148A to give an opportunity of being heard to the assessee under 148A. Okay. Now, after 148A is given, 148A we will see in the next page. After 148A is given, AO will serve on the assessee a notice requiring the assessee to what? Furnish the ROI, that is return of income, within a specified period. So the period within which the return has to be filed will be written in the income tax notice only. So try to understand the first step. First step is not 148. First step is 148A. Send a notice, show cause notice, assessee will reply, and then you can take a call of sending a notice under 148 telling the assessee to file the return. Okay. Now, is any prior approval to be taken? That we will see after some time. Some approval also has to be taken before issuing the notice. Now pay attention. Now the most important part of this section comes over here. 148 notice should not be sent unless and until the AO has information which suggests that there is an income escapement to charge. So AO should have an information which it means AO should have some kind of proof which suggests that income chargeable to tax has escaped assessment. Now this entire phrase is defined by the government of India in the form of an explanation over here, and there are 5 points over here. If any of the 5 points are happening, then it can be said that income chargeable to tax has escaped assessment. If any of the 5 points are happening, then it can be said that income chargeable to tax has escaped assessment, and if that be so, then only the AO can issue notice under 148. Without happening of these 5 points, without happening at least one of the 5 points, the AO does not have the power to send what? Notice under 148. So now let's see, what do I mean by the phrase the income, the information which AO which suggests that the income chargeable to tax has escaped assessment? Point number 1. Now there are substantial amendment made by Finance Act 2022. First point and second point are slightly changed, and so third, fourth and fifth point are absolutely new point added by Finance Act 2022. So this section, this explanation is completely revamped. So it's absolutely a new provision, as you can see over here. So what are the cases because of which the AO can send you notice under 148? First is the AO has information in the risk management strategy formulated by CBDT. Sir, what is risk management strategy formulated by CBDT? Say AO has information in the CBDT system, that is in AIS, that is in SFT. So if he gets an information from there, then he can send you a notice under 148. Or AO has some audit objection made by some auditor. Some audit report, auditor has made an objection that this much is an escaped income, this much is an unallowed depreciation, this much is the unallowed deductions taken by the assessee. So AO can send you notice based on that, because that can be considered as what? Information which suggests that income chargeable to tax as escaped assessment. Third point, the AO has information from DTAA, that AO has information from foreign tax authority. On the basis of that also AO can send you notice under 148. Fourth point, AO has information made available under 135A. Sir, what is 135A? 135A covers lot of sections like survey, like collection of information, like calling information. Do you remember in income tax authority powers we have seen lot of sections like 133, 133B, 133A, all those things. So if AO gets information from those places, like if AO has called information and from that information it is suggesting that assessee has escaped income, or AO has collected information by going to assessee's premise, and from that information if AO comes to know that assessee has escaped assessment, then also the AO can go give notice under 148. And last but not least, the AO has some information through what? Judgment of a tribunal or high court, that is a subsequent development in law. There is some tribunal judgment, there is some high court judgment, there is some Supreme Court judgment which says that this income should have been taxable. So on the basis of that, the AO can send you notice under 148. So these are the 5 cases in which the AO can send you notice. If either of the 5 points are happening, the AO has the power to send you the notice under 148. But there are some cases, there are 2 cases in fact, where the AO need not have these things. He is deemed to have information. He is deemed to have information means he need not have these things in some cases. Which are those cases? That is, if the search is happening on or after 1st April 2021, then he will by default send you a notice under 148. He does not have to prove these 5 points. These 5 points are not applicable for search cases. If a survey is happening on or after 1st April 2021, other than a TDS survey or TCS survey, for TCS survey, he has to prove the 5 points. But for other than TDS and TCS survey, he need not prove any point. And point number 3 and point number 4 is also for search and seizure. So if a search, you just remember the synopsis of these 4 points. If a search is happening on or after 1st April 2021, or if a survey is happening on or after 1st April 2021, other than the TDS or TCS survey, by default, the AO has the power to send you notice under 148. He does not have to prove these 5 points. No need to prove these 5 points. Now, before issuing notice, he also have to take a prior approval under section 151 with certain authorities, which we will see after some time. Okay. Now, let's go ahead and understand the provision of what? 148A. As I've told you, before issuing a notice under 148, requiring the assessee to file the return, you have to send a notice under 148A first, right? So now let's talk about the inquiry which the AO has to do before issuing the notice. So it is written in the step number 1 that before issuing the notice under 148, the AO shall conduct inquiry with the prior approval of specified authority. What will he do for the purpose of conduct inquiry? He will send a notice to the assessee and he will give an opportunity of being heard to the assessee, and he will ask the assessee, show me a cause why a notice under 148 should not be issued against you for this information which we have. Department has got some information, so they have to give an opportunity of being heard to the assessee under section 148A. Now, what is the time limit that the department will give to the assessee? The department will give minimum 7 days and maximum 30 days to the assessee to reply. The assessee can ask for extension and they can give you the extension also beyond 30 days also. Okay. Now, after that, the AO shall consider the reply of the assessee. The reply of the assessee shall be considered, and then the AO will decide whether it is a fit case for section 148 or not. Okay. After the assessee's replies has been received, then the AO will decide whether it is a fit case of section 148 or not, and then the AO will pass an order under 148D. The order can be either of the side, either to initiate 147 or to drop 147. Either of the case, the AO has to pass an order. What is the time limit? Within 1 month from the end of the month in which the reply under 148C was received. So when the reply was received, within 1 month from the end of the month, the AO has to pass an order that whether to consider the case or whether to not consider the case. What if the assessee does not reply to this show cause notice? Then also the AO has to pass an order. Then in that case, the AO will pass the order within 1 month from the end of the month in which the time or extended time is expiring. Okay. So whether the assessee replies or not, the AO has to pass an order. In either of the case, the AO has to pass the order within 1 month from a particular time. Okay. Now, is it necessary to conduct this inquiry in all the cases? No. In some cases, it is not necessary to conduct this inquiry. It means the AO can send the notice under 148 without conducting this inquiry. It is not necessary that for every case of assessment under 147, conducting of this inquiry is mandatory. It is not. So, which are those cases in which conducting of inquiry is not mandatory? It is not mandatory in case of search and seizure if it is conducted on or after 1st April 2021. So, it is not mandatory in case of search and seizure. Sir, what about survey? In case of survey, it is mandatory to conduct this inquiry. Survey is not mentioned over here. And the second case is 135A cases. It is not mandatory to conduct that inquiry under 148A. So in case of 135A cases like collection of information, like calling of information, etc., those section 133, 133B, if they have already initiated, they don't have to conduct this inquiry under 148A. Be very careful. Okay. So these are the two sections which are very much related to each other, 148 and 148A. 148 is the notice which you will send to file the return, but before that you have to conduct inquiry under 148A. And for some cases there are exceptions under 148, and there are some cases for exceptions which are there under 148A also. Okay. Now after that, the AO will pass an order under 147. Okay. Now, the government has said that if the AO is passing the order with respect to what? Some special cases like search, survey, requisition to reduce unavoidable inaccuracies, they have to take, listen carefully, if the order is passed by AO below the rank of JC, if the order is passed below the rank of JC and they are passing the order in respect of this high command cases like survey, search, requisition, then they have to take an approval of what? They have to take an approval of additional commissioner, additional director, joint commissioner, joint director in respect of the assessment. So if the AO is below joint commissioner and they are doing some high fund cases like survey, search, acquisition, etc., then they have to take approval from these four authorities. Otherwise, their order is what? Their order is invalid. Okay. Let's come into the next point. That is very important point for us. That what is the time limit to issue notice under 148? The time limit to issue notice. This notice, there has to be some time limit not to send this notice to requiring the assessee to file the return, right or not? This notice has to be sent up to a particular time. Now, you cannot send this notice after 50 years. Yeah. You cannot send this notice after 200 years. You cannot send this notice after 35 years. There has to be some time limit to send this notice. So what is the time limit? There are two time limits which are given by the government. One is normal case, one is special case. Normal case, what is the time limit? The notice can be sent within 3 years from the end of the relevant assessment year. So for example, for previous year 22-23, the assessment year is 23-24. So from the end of the relevant assessment year, that is 23-24, 3 years. That is till 31st March 2027, the notice can be sent. So the law used the word send. The law used the word issue. Issue means send. It has to be sent by the department within 3 years. It may be received by the assessee after 3 years also. So by 31st March 2027, the department has to issue the notice, send the notice. The assessee might receive the notice even after 3 years. That is after 31st March 2027. Now this is a case of normal case. What about in specific case? In specific case, the notice can be sent beyond 3 years, but up to 10 years also, where the AO has some evidence. What evidence AO has? That assessee has escaped income, and that income is in the form of an asset. That income is in the form of an asset. Which asset? Assessee has escaped income of 50 lakh rupees or more, first of all. For whichever year the assessee has escaped an income of 50 lakh rupees or more, and that income is represented in the form of an asset. What do I mean by the term asset? The asset is defined over here. Asset includes 4-5 items. That's it. Immovable property, shares and security, loans and advances deposited in bank. That's it. This is an exhaustive list. So listen carefully now. If the AO has evidence that the assessee has escaped income of 50 lakh rupees or more for a particular year, and that income is represented in the form of an asset, and that asset represents these 4 assets, then the AO can issue notice even beyond 3 years but up to 10 years. So whichever year, so this 50 lakh rupees or more is for per year. It is 50 lakh or more. It is not more than 50 lakh. Even if it is 50 lakh, you will be trapped between 3 years to 10 years. So be very careful. Second, if you have incurred some expenditures, if you have incurred some expenditures, which is in relation to an income of 50 lakh rupees or more, in relation to any event, function, etc., then also you can get trapped for a period of 3 years to 10 years. Then, if you have passed some book entry, some wrong bogus expenses, and the bogus expenses amounts to 50 lakh rupees or more, then also you can get trapped for what? Beyond 3 years and up to 10 years from the end of the relevant event. So the next 2 points are added by Finance Act 2022. Earlier, these 2 points were not there. Earlier, only asset point was there. But now, even the expenditure point has been incurred by the department, and even the entries in the books of accounts point has been inserted by Finance Act 2022. Okay. Now. Or if the AO wants to issue notice for more than 1 year, he has to send the notice separately for each and every case. Okay. Now, below this, there is some old time limit. What was the time limit earlier before 1/4/2021? I have told you in the class that earlier the provisions of search and seizure was separate. The provisions of income escaping assessment was separate. So I'm not interested much in the old time limit. I am actually not interested in the old time limit. I'm only interested in the new time limit. So that is the reason I have just put it for the sake of reference. They are not going to ask you the old time limit. They are going to only ask you the new time limit. So I'm coming to the next part, and that is we need to take a sanction from higher authority before sending the notice under 148. So which is that authority? So if it is a case of 3 years or less, then you have to take an approval from what? Principal CIT, Principal Director of Income Tax, CIT, or Director of Income Tax. And if it is more than 3 years case and up to 10 years case, then you have to take an approval from Principal Chief CIT, Principal Director General of Income Tax, or where there is no Principal Chief CIT, Principal Director General, then principal CIT, principal chief CIT or principal chief CIT or CCIT or DGIT as that, or there is just a second. I'll just again repeat. If there is no principal chief CIT or principal director general, then you have to take from chief CIT or director general of income tax. Okay. Now, there is one very famous case law of Sun Engineering Limited. Now, what has happened in that case? I'll tell you first of all what has happened in that case. Suppose in 2015, 2016, there was a case in which the AO, the assessee's income was approximately, say, assessee has shown an income of say 15 lakh rupees in the ROI. Pay attention, please. It's a very important case law. I'll just put numbers over here. So suppose there is a case in which in 2015-16, the return of income of the assessee shows an income of 10 lakhs. Now the AO, listen carefully, this is the most important part of this discussion. Now the AO added 15 lakh rupees, wrongly disallowed. It was even though allowed by Supreme Court in some cases, but it was wrongly disallowed by the AO. The AO wrongly disallowed it, okay. You did not appeal, you did not file a rectification, you did not file a revision application, you did not file any remedy. The AO wrongly disallowed and you were silently accepting that, okay. Now, after a few years in 2021-22, the undisclosed income was found and AO wants to do 147 assessment against you. So, AO told you to file the return. So, what you did, you filed the return, you showed income of 125 lakhs and this expenditure which was wrongly disallowed earlier, you are taking that as a deduction. You are taking that as a deduction. So, the entire question is that only the deduction which was disallowed earlier, even though it was wrongly disallowed, can it be allowed against the escaped income under 147? The Supreme Court said that no, it is not allowed. Section 147 is not for the benefits of the assessee. The expenditure which was disallowed earlier, that matter is closed. You should have appealed earlier. Why the hell you have not appealed? Why the hell you have not appealed earlier? You will not be allowed to get this deduction and your income will be escaped at 25 lakhs only. You will not be allowed to reduce that. You should have appealed that particular expenditure earlier. But then the government came up with some small amendments which says that if that escaped income, that is 25 lakhs, is greater than your wrong disallowance, that is your, how much is your wrong disallowance? 15 lakhs, which is greater, then this case law will apply and accordingly you are not going to get this deduction. But if your escaped income is 15 lakhs and if your wrong disallowance is 25 lakhs, then 152(2) will apply and 147 provision has to be dropped. Then the department has to drop section 147. So be very careful. When the Sun Engineering case law will be applicable and 152 subsection 2 will be applicable. 152 Sun Engineering case law will be applicable when your escaped income is more and your wrong disallowance is less. So then Sun Engineering case law will applicable and then 147 provision will apply. And if your escaped income is less and your wrong disallowance earlier was more than even your escaped income, then 152 subsection 2 will apply. 147 provisions have to be dropped. 152 subsection 2 talks about dropping of the provisions of income tax assessment. So this talks about the AO has to drop the proceedings when your escaped income was less and your wrong disallowance was more. So you have to drop the 147 proceedings. Okay. And the last thing over here is if you are doing assessment of earlier years in the current year, what would be the tax rate? The tax rate would be of the current year or the tax rate would be of the earlier year. The tax rate would be of the respective years to which the income relates. The tax rate would not be of the current year. It would be of the respective year. Just check it. And last thing is we have to do the time limits of 143, 144, 147. What is the time limit to complete assessment by the AO? That we will see in the chapter time limit later on after some time. Okay. Let's move on to the next chapter. So now let's talk about this remedy which talks about rectification of apparent mistakes. Now who will rectify this mistake? This mistake is rectified under section 154 and it is rectified by income tax authority. Income tax authority means any income tax authority. Whomsoever has made a mistake will rectify the mistake. What kind of mistake are rectified? Apparent mistake. Mistakes which are apparent from record. Mistake apparent from record means what? Mistake apparent from record means which is very obvious, which is very glaring, which is very something where there is no two views possible, that anybody would say that there could not be any argument also about that mistake. It's a mistake, it's a genuine mistake that anybody would raise. They would say that yes, it is a mistake. So it is something which is a genuine mistake, is known as apparent mistake. Okay. Now where is the mistake? The mistake can be in any order passed by income tax authority. The order can be assessment order, appeal order, revision order, rectification order, penalty order, prosecution order, or any other order. Whichever order is passed by income tax authority, they can rectify it. Sir, whether the ITAT will also rectify its order under this section? No. ITAT is not an income tax authority. ITAT cannot rectify its order under this section. ITAT has to rectify its order under section 254 subsection 2. That is a separate provision made over there by the government. Secondly, not only the orders are rectified, but also the TDS intimation, the TCS intimation, and even the income tax returns intimations are also rectified over here under this particular section. Okay. Now how this proceeding is done? This is also a proceeding. Yes, rectification is also a proceeding which is under 147-54, and here also the respective authority will pass a rectification order and then we can say that the proceeding is completed. Sir, what if the assessee does not happy, is not satisfied with the order under 154? Then the assessee can file an appeal to CIT appeal, or we can file again rectification application, can also go for revisionary proceedings. under 264, the assessee has all the three doors open for the purpose of further remedy. Okay, next, can I rectify an order based on a Supreme Court judgment? Yes, why not? Suppose if a Supreme Court judgment comes today in some other case that this expenditure is disallowed, or this expenditure is allowed, or this income is taxable, or this income is exempt, on the basis of that the AO can rectify your order, because it can be said that the AO has made an apparent mistake earlier because AO did not pass the order properly as per the Supreme Court judgment. Therefore, if there is a Supreme Court judgment, based on that you can rectify your order under 154, but based on the High Court judgment you cannot, because High Court judgment can have different opinions in different states, and therefore that is not allowed. Who can initiate the rectification proceeding? It can be done suo motu by the income tax authority, or even assessee can give an application, and even AO can give an application to CIT appeal and tell the CIT appeal that I have made some mistake, you please rectify the thing. If the liability increases, the department will give you what? An opportunity of being heard. Definitely. Now, the time limit for passing the order. What is the time limit for rectifying the order by the department? Now, by default, the department has to rectify the order. If they suo motu rectify, then they have to rectify the order within 4 years from the end of the financial year in which the order sought to be rectified was passed. So, whenever the order was passed, within 4 years from the end of that financial year. But if the assessee gives an application, then the department has to be faster. Then the department has to pass an order within 6 months from the end of the month in which the application is received. And if they do not pass the order within 6 months, it is deemed to be in the favor of the assessee. If the department does not pass the order within 6 months of the month of the application, then it is deemed to be in the favor of the assessee. So, what is the time limit for rectification application? This is the time limit for passing the rectification order, by when the assessee should make an application. For that, the CBDT has given a circular which says that you have to make an application at least within 4 years. If you make an application within 4 years, that is within this much time which is mentioned above on the left hand side, then the department will consider your case and will allow your application on your merit. We will consider your case. Okay, don't worry. Then a very important case law of Hind Wire Industries Limited. Be very careful. What has happened in this case? Let me give you an example. There was one assessee in whose case the AO passed an order and there were two apparent mistakes. Now, after 3 years, the assessee made an application to rectify one mistake. Listen carefully. There were two apparent mistakes made in the order. Go in the sequence. There were two apparent mistakes made in the order. After 3 years, the assessee made an application for one mistake. The AO rectified one mistake and passed a rectification order. Now, after 3 years from there, from the rectified order, again after 3 years, the AO passed. The assessee made application for the second mistake, because in the original order there were two mistakes. The assessee made application for the second mistake. The AO rectified. The AO said that the time limit to rectify this order has gone, because the 4 years from the original order has gone. So now the question is whether we should count 4 years from the original order or whether we should count 4 years from the rectified order. The Hind Wire Industries Limited and Tony Electronics Limited, both of them have said that the 4 years period has to be counted from the rectified order and not from the original order, because the rectified order itself is what is having a mistake. The rectified order should have rectified both the mistake. It has rectified only one mistake. Therefore, the 4 year time limit should start from the rectified order and not from the original order. Check it over here. And one last concept over here is doctrine of partial merger, which is applicable here also. Doctrine of partial merger is applicable under two provisions of income tax law. One is section 154, second is section 263. And there is one provision under income tax law where doctrine of complete merger is applicable, and that is section 264. So, what is doctrine of partial merger? Doctrine of partial merger means if an order of AO is a subject matter of appeal, then if any matter of that order is subject matter of appeal, the AO cannot rectify that matter under 154. Suppose there are 4 expenses in the order of AO, A, B, C, D, and one of the expense you have appealed. So that expense cannot be subject to 154. Can I take other 3 expenses in the 154? Yes, you can take the other 3 expenses in the 154. You cannot take the expense which has been subject matter of appeal or revision. This is what doctrine of partial merger is all about. And one last thing is the rectification proceeding. This is also going to be now what? Faceless, as said by the government. You can check it. Government is going to make this also what? Faceless. So let's go ahead with the next remedy, and that is what? Appeal, appeal and appeal. After rectification, we are going ahead with the appeal remedy. Okay, now, which is the first appellate authority for assessee? The first appellate authority for the assessee is always CIT appeal. Now, if the order is passed by an authority below the rank of CIT, that is an assessment order or penalty order or any other order, and if the assessee is aggrieved, then the assessee has to file an appeal to CIT appeal. In which form? Form number 35. In how many days? Within 30 days after the receipt of notice of demand. Within 30 days after the receipt of notice of demand. Can the CIT extend? Yes, it can extend. You also have to file grounds of appeal. Okay. Now, before you file an appeal, you need to also understand that now even the intimations under 143(1) or 206 can also be appealed after Finance Act 2012. Earlier, intimations were not supposed to be appealed. Now, you can even file an appeal against an intimation. Okay. Now, before you go for an appeal, you also have to pre-deposit your tax and penalty. You have to pre-deposit your tax. Now, whatever is the disputed tax which is raised by the assessing officer, you have to pre-deposit that tax. Sir, is there any relaxation in that? Can I get a stay of demand? Yes, you can get a stay of demand beyond 30 days. If you give a genuine reason, they can give you, or a stay of demand, they can give you some relaxation, put a stay on that. In this also, you have to pay only 20% of the tax, not the entire tax. If you pay 20% of the tax, you will be allowed to appeal to CIT appeal. But if you don't have that 20% money also to appeal, you don't have that much funds also, you have financial crunch in your business. So in that case, you can go for what? You can go for a stay of demand. You can make an application to CIT appeal and he will allow you, and he will give you a stay on the payment. Okay. Now during the hearing, there will be a lot of adjustments, some adjustment will be made by the SSE, some by the officer, some by the CIT appeal, as the case may be. Okay. Now during the hearing, there might be two important factors which can arise. One is additional grounds and additional evidence. We need to understand these two concepts one by one, and we need to understand what exactly these concepts are and when this can be enforced. First of all, what is additional ground? Additional ground means a new subject matter. Suppose you have appealed initially on depreciation. You are having dispute with respect to depreciation. Now you want to appeal with respect to 37(1) also. So now this is altogether a new matter. So if you raise altogether a new matter, that is known as additional ground. So when can I go for an additional ground? Can I go for additional ground in front of CIT appeal? Yes, you can go if that omission of that ground was not willful and not unreasonable. So if the omission of that ground was not willful or unreasonable, then you can go for it. So when you omitted that, you are not having an imagination of omitting that. You are not aware only of this is also an issue. Later on you came to know. Then you can go for what? You can go for what? Your additional grounds. You can make an application to CIT appeal and CIT appeal will allow you that additional ground. Now what is additional evidence? Additional evidence is not a new ground. It is the same ground, in respect of which there are some new evidences which you want to put. Suppose there was some depreciation which was disallowed by the AO earlier, so you appealed against that. Now you are not able to put forth the evidences in front of the AO earlier, so now you are putting forth the evidences with respect to the same matter in front of CIT appeal. That is known as additional evidences, and additional evidences can be given in 4 circumstances as per rule 46A. What are the 4 circumstances? You can see the 3 circumstances over here, and the 4 circumstances is on the next page. So what are the 3 circumstances? And the 4th one, this is also there in your indirect tax in GST also. You can go and see over there exactly in the same manner it is there in GST also. Now let me talk about one by one. The first situation in which the AO has to admit the additional evidences. For example, the AO while passing the assessment order did not consider a CBDT circular. So I said to the AO, don't worry, I will go to CIT appeal and I will put forth this evidence in front of the CIT appeal and they will consider as per rule 46A. So AO should have, because CBDT circulars are bound on the assessing officer. They have to bind, it is binding effect on the assessing officer. They have to follow this. They have not followed it. So I will give that particular thing to CIT appeal and I will tell CIT appeal something which was bound to be followed by your officer, he did not follow, so you allow me that, and the CIT appeal will allow you as per this rule. Next, where the AO has not given you sufficient opportunity to present any evidence. For example, you ask the AO that I want 15 days to present this evidence. AO said that no, I am not going to give you 15 days. You have to pass that, but you have to give the evidences by tomorrow itself. Tomorrow evening, if you give the evidence, I will consider, or else I will pass the order disallowing the expenditure. I said that you should give me some reasonable time here. I have to take the details from my creditors. I have to take the details from my debtors. I should get some time. He's saying I'm not going to give you time. Don't worry, don't give the time. I will go to the officer, I'll go to the CIT appeal and put forth this evidence in front of him. This is called as additional evidence. Third one, there are some evidences which are called upon by the AO, but you are prevented by sufficient cause. You are not able to give that evidence to the AO. Why? Because it is possible that when the assessment was going on, the AO was calling for some information, some documents, some books of accounts, but you are not able to give that. Why? Because that were already confiscated by the excise department or by the GST department or by the FEMA authorities or by the PMLA authorities. So if that is already confiscated by the other authorities, how will I present that? Don't worry, don't present. You can present that in front of CIT appeal and he will consider that. Next, you are prevented by sufficient cause. Again, the AO did not ask only and AO passed the order. For example, in case of 144, you know that in some of the cases in 144, the AO did not issue your show cause notice also. Do you remember that? Where you regularly change your books of accounts from mercantile to cash, cash to mercantile, mercantile to cash, cash to mercantile, the AO directly passes an order. Suppose the AO directly passes the order and give you the assessment order and he did not ask you for any documents. Don't worry, you can put forth that documents in front of what? CIT appeal and he will consider your additional evidences. So these are the 4 circumstances in which the CIT appeal will consider your additional evidences. So this is what additional grounds and additional evidence is all about. After that, the CIT will pass an order. What is the time limit to pass an order? Within 1 year from the end of the previous year in which an appeal is filed, even though this time limit is recommendatory, not mandatory in nature. Now, what is the scope of the CIT's order? The CIT's order can confirm the AO's order, can annul means cancel the AO's order, or can modify on higher side or lower side the AO's order. But CIT does not have the power to cancel and redirect a fresh assessment to the assessing officer. That power is available with CIT appeal. That power is there with ITAT, CIT under 263 and CIT under 264. Cancelling the assessment of AO and redirecting for fresh assessment is not the power with CIT appeal. Okay. Now, next. Appeal to tribunal. Now, who is aggrieved now? Now, there can be 2 parties who are aggrieved. Either the assessee can be aggrieved and even the department can be aggrieved. whomsoever is agreed with the order of CIT or CIT appeal, whatever orders are passed by CIT under various provisions of the income tax law, whomsoever is aggrieved will file an appeal in form number 36 within 60 days from the date of receipt of the order, and the other party, that is the appellant, will file an appeal, and the respondent will file what? A memorandum of cross objection within 30 days from the receipt of the notice in form number 36A. So the appellant will file an appeal under 36 within 60 days, will file an appeal under form number 36 in 60 days, and the respondent will file memorandum of cross objection within 30 days in form number 36A. This 60 days and this 36 days, this 30 days time limit, both can be extended by ITAT if there is a sufficient cause. Okay, if there is a sufficient cause, ITAT will extend that time. Now, during the ITAT hearing, can additional grounds be considered by ITAT? Yes, ITAT can consider additional grounds if it is necessary to consider on a case-to-case basis. Can ITAT consider additional evidence? Yes, ITAT can consider additional evidence if it is considered to necessary. If it is necessary to consider. It depends upon the mode of the ITAT. It depends upon the ITAT's decision. There is no specific provision. There are no 4 conditions like it was there in CIT appeal over here. In CIT appeal, there were 4 conditions in which additional evidences can be considered. But here there is no 4 conditions. Okay. Now then the ITAT will pass the order, and the order passed by the ITAT can be of 4 types. Either ITAT will pass the order at its end, or ITAT can remand back the case to AO for fresh assessment. Both the possibilities are there. What will do ITAT at its end? ITAT can confirm the order of CIT appeal that it is correct, or it can modify the order of CIT appeal. It can reduce the liability, etc., or it can annul the liability of the CIT. It can annul means it can cancel the liability. It can cancel the order of the CIT. Now, apart from these 3 powers were there with the CIT appeal also, but the 4th power was not there with the CIT appeal. This power is there with ITAT, not with the CIT appeal. Now there are a lot of questions that we need to answer one by one. Very important question. Now this first point is extremely important. This is taking U-turn like this. So pay attention please, all of you. What is the time limit for ITAT to pass an order? There are multiple time limits over here. Be very careful. The first thing is the ITAT may pass an order within 4 years from the end of the financial year in which an appeal is filed. Keep this time limit in your mind. So if an appeal is filed in 22-23, within 4 years from the end of the financial year, that is 22-23, that is till 31st March 2027, the ITAT will pass an order. This is the first time limit. Second time limit, the department says that if the ITAT has granted stay, okay, ITAT may grant a stay to the assessee. Yes, there is a demand which is raised by CIT appeal. So CIT appeal, so assessee has to pay that demand to file an appeal. But the government says that the ITAT will grant a stay. Don't worry. But on a condition that the assessee deposits at least what? 20% of the amount of tax penalty, or at least furnish security of that much. So if an assessee can give a 20% tax, or at least furnish that much security, suppose if the tax liability is 1 crore rupees. So if the assessee can pay at least 20 lakhs, or at least furnish security of 20 lakhs, then the ITAT may grant stay also. So now listen carefully. So by default, step by step, we have to go. Point number 1 says that the ITAT has to pass an order within 4 years. The point number 2 says that the ITAT can grant you stay if you pay 20% tax, or at least equivalent to that much security. The point number 3 says that once the ITAT has granted you stay, listen carefully, then the ITAT has to pass an order within 180 days. Now listen carefully, don't look into books. Don't look into the books. Once the ITAT has given you stay, then the ITAT has to pass the order within 180 days. Can that be extended? Yes, it can be extended to 365 days. But if the delay is because of the department, if the delay is because of assessee, then it cannot be extended. So if the delay is because of ITAT, it can be extended to 365 days. So by default, the ITAT can give you a 180 day stay, and they will pass the order also in 180 days. If the delay is because of assessee, they will pass the order also in 180 days, and the stay will cancel after 180 days. After 180 days, assessee has to pay tax. If the delay is because of ITAT, then they have to extend by 360 up to 365 days. What if the delay is beyond 365 days because of department? So the Supreme Court has come into the protection of the assessee and says that if the delay is beyond 365 days because of the assessee, then the ITAT can pass the order. Then the stay will vacate. Stay will over. But the delay is beyond 365 days because of the ITAT, then the stay cannot stop. The stay will continue. The stay will continue. This is what the department has to say. So be very careful. By default, the ITAT will pass the order within 4 years. But there are some exceptional cases in which they have to pass the order within 180 days or within 365 days. That are the cases of stay. If the ITAT has given you stay, then pass the order within 180 days. If the delay is because of ITAT, it can be extended up to 365 days. If the delay is because of ITAT, the Supreme Court said in the case of Pepsi Food, it will be further extended beyond 365 days also. Check it please. Because there is no mistake of assessee. Yes, if the delay is attributed to the assessee, then it has to be passed within 180 days or within 365 days. It cannot be extended beyond 365 days. Check it please. Next question. Where the ITAT has remanded back the case to the AO, can the AO start a new matter? No, the AO has to confine to the directions given by the ITAT. If the ITAT has given a direction to start to look into the depreciation issue, so the AO will only look into the depreciation issue and pass a fresh assessment order. The AO cannot look into the new matter. Check it, please. Next. If the ITAT has redirected the matter to AO for financial year 22-23, can the AO open 21-22, 2021? No, that is not allowed. AO is only supposed to open that year which has been referred by the ITAT. The AO cannot reopen other sections. That is not allowed. Next, can ITAT review its own order? No, ITAT cannot review its own order. Review means what? Changing its view. The view which was taken earlier, the ITAT wants to change that view. That is not allowed. It was said by Bombay High Court in the case of Ernest Exports Limited that changing its view is not allowed. Yes, if there is an apparent, suppose ITAT has passed an order and after a few months, ITAT feels that I should change my order. They cannot do that. That is not allowed. Yes, if ITAT has passed an order in which there is an apparent mistake, it can rectify its mistake under section 254 within 6 months. It can rectify its mistake. It can rectify its mistake. Assessee can also make an application within 6 months. If an assessee makes an application within 6 months, then they will consider the application. So assessee can also make an application. So they will suo motu rectify within 6 months. If an assessee makes an application within 6 months, then also they will rectify. But if an assessee comes beyond 6 months for an application, then they will not rectify. So there is a difference between reviewing and rectifying. Be very careful. Now, who is there in ITAT? There are how many members? There are 2 members in ITAT. One is judicial member, one is accountant member. Always there are 2 members? No, no. If the total income is up to 50 lakhs, then there is only 1 member. There is a single member bench. But if the total income is more than 50 lakhs, then there are 2 member bench. Okay. Now, what will be the how the decision will be taken if there is a judicial member, there is an accountant member, and they have difference in opinion? If there is a difference in opinion, how the matter will be resolved? This is issue number 5. If there is a difference in opinion, then the matter will be resolved by the president of the ITAT. The president of the ITAT will call all the judges. All the judges will sit together along with these 2 judges who are giving the judgment, and they will decide within themselves who is going to be the correct party, whether the assessee is correct or whether the department is correct. So if there is a difference in opinion between accountant member, judicial member, the president will come into picture, will call all the judges of the ITAT and will unanimously decide between all of them that who is going to be the winner. Okay. Next. Can the assessee go to the ITAT and urge new grounds of appeal? Yes, you can go to the ITAT and urge new grounds. That is the power which is given to the ITAT. That power is not given to the assessing officer. In case of assessing officer, if you go to the assessment and tell the assessing officer to take new matter, he will not take new matter. He will tell you go and file revised return. It was written in the Supreme Court judgment of Goetz India Limited, if you remember. But in case of ITAT, the ITAT has the power to consider what? New matter. Check it, please. Check it. Is it clear? Next. Can the ITAT decide the case without looking into the merit? What happened actually in one of the case? What happened? The assessee did not appear in the court on time. So assessee did not appear in the court on time. So the ITAT passed the order against the assessee without listening to the matter. Can ITAT do that? The answer is no. The ITAT cannot do that. So but the Madras High Court has held that in the case of Srimati Rita Sabapati, that ITAT cannot pass an order against the assessee without looking into the merits. You have to look into the merits. Just because out of egoistic order cannot be passed. Just because the assessee did not appear on time, you cannot pass an ex parte order, best judgment order. That is not allowed. You have to give an opportunity to the assessee, and therefore the order passed by the ITAT is incorrect. And the last but not least, that is a conclusion over here which we need to do over here. That is, ITAT is the last fast fact finding authority. If you want to go beyond this, that is if you want to go to High Court or Supreme Court, then you need to go with a question of law and not question of fact, because question of fact under income tax law cannot be appealed in High Court and Supreme Court. So what do I mean by question of law? Question of law means a issue which is an interpretation of law, which is debatable in nature, for which there is no clarity in law, for which there is no previous authentic judgment. And then the matter will be decided by High Court and Supreme Court. In High Court and Supreme Court, question of facts are not taken away, not taken ahead. Only the question of law which is taken ahead in High Court and Supreme Court. And then the High Court and Supreme Court will decide the case. In High Court, the matter is decided by Code of Civil Procedure 1908 and not income tax law. The procedures of High Courts will be followed as per the Code of Civil Procedures 1908. Plus this CIT appeal and faceless. That ITAT is also going to be faceless now. The government has said that the CIT appeal and ITAT appeal is going to be faceless now. And last but not least over here is, if you want to appeal to High Court, you have to appeal within 120 days. And if you want to appeal to Supreme Court, you have to appeal within 90 days. Check it, please. So now let's go ahead with the next point, and the next point is a very important Finance Act 2022 amendment which has been introduced by FA 22. So to explain this particular concept, I have made a small chart over here of section 158 AB. So with the help of this chart, I'll be able to explain exactly what this particular section is trying to tell us. Okay, so you can take a photograph of this chart also later on, but let me explain you first of all what exactly this chart is all about. Suppose current year is financial year 22-23, and listen carefully. Suppose current year is financial year 22-23 and there is an AO who has passed an order against you. If an AO has passed an order against you, what will you do? You will appeal to CIT appeal. So you went to CIT appeal and the CIT appeal has also passed the order. Now the CIT appeal has passed the order in favor of you. So CIT appeal has passed the order in favor of you and your matter was depreciation. You were fighting for some claim of depreciation and the CIT appeal allowed you. So CIT appeal allowed you and that depreciation is allowed to you as per CIT appeal and it is a question of law. Now, if department has lost at this case, at this level department has lost, what department will do? Department will file an appeal. But now the real picture will start. Department is thinking about filing an appeal. Why? Because department feels that a similar matter of depreciation which the department has lost here is already pending in High Court and Supreme Court in case of this assessee or in case of any other assessee. Already department has filed a case which is already pending in High Court and Supreme Court of a similar level of depreciation, So in that case, it will lead to what? Repetition. Because already for 1920, a similar level of claim is already pending in High Court and Supreme Court. What sense does it make now to again appeal in tribunal or appeal in High Court? It doesn't make sense. So for that purpose, the government said that we will make one collegium. Now let's come to right hand side. Collegium means a group of 2 or more CITs or chief CIT. They will make one collegium and the collegium will look into such matters. And if the collegium feels that there can be repetition, the collegium will tell the CIT and CIT will accordingly tell the AO that we are not going to appeal. And accordingly, the AO will make an application to tribunal and High Court and AO will also tell the assessee that we are not appealing for the current year because the similar matter for earlier year is already pending in High Court, is already pending in Supreme Court. So we are not filing an appeal. So the CIT will tell the AO will tell the tribunal and High Court as the case may be that we are not filing it as of now. But whenever the final judgment of 1920 will come into picture, at that time we will file an appeal. Till that time, we are not going to file an appeal. In this case, you also have to inform the assessee. If assessee agrees, well and good. If assessee doesn't agree, then the department does not have any option apart from filing what? An appeal. So this entire process is explained with the help of objective of not having a repetitive appeal. Department does not want the same matter to be getting appealed again and again. Because in 1920, if depreciation is already pending in High Court and Supreme Court, what sense does it make to again appeal the same matter in 22-23? Because ultimately the judgment, whatever it will come, it is going to be the same only. Okay. Now, I am not able to tell each and every word of this section in detail because it's a complete procedure, but I have tell you the entire gist of the provision in detail. But I have not told you all the time limits, etc. over here. For that, you can refer the provision in the book and you can read it once. You will understand everything. Don't worry. Okay. Just take a photograph of this and then we'll go ahead. After this, let's go ahead with the next part. Next part is what? Next part is section 268A, which talks about what is the monetary limit after which the department will file an appeal. Now, the department has set certain monetary limits for filing appeal by department. Now, when an assessee has to file an appeal, there is no monetary limit. Assessee can file appeal at any monetary limit. Even if it is a 1000 rupees case, assessee can file an appeal. But for department, there is a monetary limit fixed by the department. That is, if the department has to file an appeal in ITAT, then the tax effect has to be greater than 50 lakh rupees. If the department has to file an appeal in High Court, tax effect has to be greater than 1 crore. And if the department has to file an appeal in Supreme Court, the tax effect has to be greater than 2 crore rupees. Now, you will definitely ask, what do you mean by the term tax effect? Tax effect means the current tax minus the estimated tax if the department wins. Suppose the current tax is 1 crore. And if the department wins, then the estimated tax is 2.5 crore. Then the difference between these two will be considered as what? As your tax effect. So this is what this tax effect, what it means. Okay. Now. Suppose. Sir, is it mandatory that department will only file an appeal if it crosses this limit? Yes, it is mandatory to file appeal if it crosses this limit. Sir, what if the amount of tax effect is within the limit? It means if the amount of tax effect is below the limit, can the department still file an appeal? Yes, nobody can stop them to file an appeal. These are for internal purpose of department. The moral of the story of these limits is what you know. If the tax effect exceeds this limit, then the department has to file. But if it is below this limit, then it is at the discretion of the department. If they want to still file, they can file it. You cannot tell the department that why have you filed the appeal because the tax effect is just 42 lakhs. Why have you filed the appeal because the tax effect is just 30 lakhs. If they wish to file, they can file it. It depends upon their mood. It depends upon their work pressure, workload and many other factors. No. Suppose if the department has not appealed for a particular year because the limit is below the tax effect. So does that mean that your expenses are correctly claimed? Does that mean your income is exempt? No. It does not mean that your expenses are correctly claimed. It does not mean that your income is correctly exempt. It is not about that. It means that the department does not have the time. That is the reason they have not filed an appeal. They are not agreeing to your expenses. They are not agreeing to your income. Secondly, if the department has not filed an appeal in a particular matter because the tax effect is less than the limit, can the department file an appeal against the same person in the next year? Yes, they can. Can the department file an appeal in case of some other person in the same year? Yes, they can. This particular case is assessee specific and year specific. Suppose in the current year, the tax effect is 30 lakh. Department did not file an appeal. In the next year, the same case, tax effect is 30 lakh. Department is filing an appeal. Nobody can stop them. Suppose in the current year, in case of me, suppose I am Mr. A, the tax effect is 30 lakh. They did not file appeal. My brother Mr. B, in his case also tax effect is 30 lakhs. But in his case, they filed an appeal. Nobody can stop them. They are absolutely correct. They can do so. So these are the points which are mentioned over here. Okay. So here completes the entire appeal related provisions. So we have done your second remedy now. After rectification, appeal is also done. Now there is a small provision. We'll address that first, and then we'll move ahead with the third remedy, and that is revision by Commissioner of Income Tax. Before that, we have to do this small topic, that is collection and recovery. What is collection and recovery exactly? The department will send you a notice of demand under section 156. Okay. Once the assessment is done, once the appeal is done, once the rectification is done, so after that, the department can send you a notice of demand under section 156, and you have to pay the demand within 30 days. If you do not pay the demand within 30 days, then you will be called as assessee in default, and there will be 4 serious consequences against you, which I will be telling you one by one in a while. Now, the question is, can the department extend the 30 days time limit? Yes, you can give an application, they will extend the time limit. Can the department give me installment facility? Yes, they will also give you installment facility with interest, but installment, if they are going to give you, they are going to charge you interest also for the same. Can the department reduce the 30 days time limit to 10 days time limit? Can they say me that no, for you 30 days is much more than enough. You have to pay the tax within 10 days. Yes, they can reduce the time limit also if the AO has reason to believe that giving 30 days would be detrimental to the interest of revenue. If the AO has reason to believe that giving 30 days would be detrimental to the interest of revenue, it would be harmful for the interest of the revenue, they can reduce the time limit also. Okay. Now, what if the assessee does not pay the tax within 30 days? Then the assessee will be considered as an assessee in default. And then there are 4 consequences which he has to bear. First, section 220. He will be chargeable with interest at the rate of 1% per month or part thereof for calling as assessee in default. Every assessee in default is liable to pay this interest under 220 at the rate of 1% per month or part thereof. Can this interest be waived? Yes, it can be waived by Chief Commissioner or Commissioner if 3 conditions are fulfilled. It can be waived by Chief Commissioner or Commissioner if 3 conditions are fulfilled. You have to prove that there is an undue hardship on the you. You have to prove that the delay by you was beyond the control, and you have to prove that you always gave necessary cooperation to the department. HCC, undue hardship, delay was beyond cooperation, below control, and third one was you always give necessary cooperation. If you prove these 3 points, then they will waive your interest, and they will pass an order within 12 months to waive your interest or not to waive your interest. Whatever they want to do, they will do it within 12 months. Okay, next. What is the second consequence? They will impose penalty on you under section 220. They will impose penalty under section 221. Check it. Now, after interest and penalty, what is the next that the department is going to do against you? They are going to recover your tax. The tax recovery officer will prepare certificate of action and will start recovery proceedings against you. What he will do? He will attach a person. Attach means he will attach your property, movable, immovable property, all the properties will be attached. Attachment means what? You cannot sell the property. You can use the property, but you cannot sell the property. He will appoint a person for management of your property so that you should not sell illegally. So he will appoint a person. Third, he will also auction your property. He has the power to auction your property. Then again, there is a secondary recovery mode which is mentioned under 226, and in 226 there are further 4 modes of recovery. Again, the tax recovery officer will prepare a certificate of auction and will recover the tax as per the following modes. First, if you are employed under some person, he will send your employer a notice and he will tell your employer that from next month onwards you have to pay the salary to the assessee, to the government of India rather than to the assessee. Check it please. Similarly, if the assessee has sold some goods to debtor, so the department, the income tax department will send a garnishee order to the debtor and will tell the debtor that you have to pay the money to the government of India and not to the assessee. The government will send a notice to the debtor of the assessee and will tell the debtor that you have to pay the dues to the department, that is the income tax department, and not to the assessee. And if the debtor defaults, then the debtor will become what? Assessee in default, and the government will recover the tax from debtor only. Third, the department can also give a application to the court for release of property which are in the court custody. So if certain properties which are in the custody of the court, the department can give a notice, to the court and ask for a release of those property in the name of the department. And fourth, if the department wants, they can make a distrained sale of your property. Distrained means what? Distrained means a price at which it's a very negligible price. Suppose a property is of 10 crore, the department can sell it for 2 crore or 3 crore rupees to recover the tax. It's sold at a very, it's like just selling something at a value of scrap. That is known as a distrained sale. Okay, so these are the very, very dangerous recovery mechanisms which are imposed by the government of India under section 222 to 226. Okay, now let's move on to the third and the last remedy under the income tax law, which is revision of order by CIT or principal chief CIT or chief CIT or principal CIT. So there are two sections for revision, that is one is 263, one other is 264. 263 talks about revision of those orders which are prejudicial to the interest of revenue, and 264 talks about those orders which are prejudicial to the interest of assessee. Now 263 is those order in which the AO has passed an order which is prejudicial to the interest of revenue. So CIT, principal, chief CIT, etc. may call for the records and may consider that the order passed by AO or even TPO now by Finance Act 2022, now CIT can also revise the order passed by TPO. Earlier, CIT used to revise only the order passed by the assessing officer, but now the CIT can also revise the order passed by what? The transfer pricing officers under section 92 CA. So if the CIT is of the opinion that the order passed by the AO is erroneous, there is error and it is prejudicial to the interest of revenue, then the CIT will give an opportunity of being heard to the assessee and will pass such order as he deems fit. Opportunity of being heard is necessary. That is there a separate no show cause notice to be given to the assessee? No need to give a separate show cause notice, but opportunity of being heard should be given to the assessee. Now, what will be the scope of the order passed by CIT? CIT can enhance the AO's order. CIT can modify the AO or TPO's order. And CIT also has that power, which power was there with ITAT, not with the CIT appeal. CIT can cancel the assessment and direct the fresh assessment to the what? Assessing officer. This power was not there with what? CIT appeal. This power was there with ITAT. Now, there is a very important question. Now, what do I mean by the phrase erroneous and prejudicial to the interest of revenue? Is the phrase erroneous and prejudicial to the interest of revenue defined under income tax law? The answer is yes. It is defined in an explanation and in which there are 4 points. First, if the CIT is of the opinion that the AO has passed an order without making any inquiry, the CIT is of the opinion that the AO has passed an order, assessment order, without making any inquiry, or AO has given relief without any inquiry, or AO has passed an order without considering the CBDT instructions under 119. CBDT gives so many circulars, so many notifications, so many orders. So AO is bound to follow that. So CIT feels that CIT is of the opinion that CBDT circulars are not followed by the assessing officer. CBDT's notifications and orders are not followed by the assessing officer. Then it can be considered that the order passed by the AO is erroneous and prejudicial to the interest of revenue. And fourth, the CIT is of the opinion that the AO is not considering the High Court judgment, jurisdictional High Court judgment and Supreme Court judgment. If the AO is not considering the High Court and Supreme Court judgment, obviously the order passed by the AO is erroneous. It is prejudicial to the interest of revenue. So these are the 4 points. First one is what? The order is passed without making an inquiry. The order is passed without inquiring into the relief, whether the relief should be given to the assessee or not. The order is passed without looking into the CBDT instruction. The order is passed without looking into the High Court and Supreme Court judgment. Then the order passed by the AO can be considered as erroneous and prejudicial to the interest of revenue. Who will revise order under this section? CIT. Whose order will be revised? AO's order will be revised. Can an intimation or deemed intimation be revised? No. Intimation or deemed intimation is not revised under this section. If an order is passed by CIT under this section, can it be appealed? Yes, you can appeal to ITAT under section what? 254. 254 is the section of ITAT. So this order is appealable to ITAT. Okay. Is the opportunity of being heard to be given? Yes. If the opportunity of being heard is given and if the assessee proves everything correct, then you have to drop this proceeding under 263, because when you give an opportunity and the other person proves everything correct, then you have to drop the proceeding. Next is the show cause notice has to be given. As I have told you, no show cause notice is to be given, only opportunity of being heard has to be given. And last but not least, here also there is a doctrine of partial merger which is applicable. It means if there is a particular matter to which you have already appealed in the High Court or in the ITAT or in the CIT appeal, then that matter cannot be revised under 263. You can revise other matter. So what is the time limit to revise by CIT? The time limit to revise by CIT is 2 years from the end of the financial year in which the order sought to be revised was passed. Suppose the order which you want to revise is passed in 22-23. So the order which you want to revise, is passed in 22-23. So the order has to be revised within 2 years from the end of 22-23. That is till 31st March 2025. But if the order is revised giving an effect of High Court or Supreme Court judgment, then there is no time limit. It means if the Supreme Court judgment has to be, suppose some Supreme Court or High Court judgment has come because of which the order is looking erroneous and prejudicial to the interest of revenue, then there is no time limit to pass that order. The department can pass that order and revise that order even beyond 2 years. Okay. Now there is one very important case law of ICICI Bank Limited and versus and also Elegant Finance. Both of the case law same only. Just the difference is the ICICI Bank one is a Bombay High Court judgment and Elegant Finance Limited is a Supreme Court judgment. Now what has happened in this case? Let me tell you. Suppose there is an order passed by the AO. Okay. Order passed by the AO allowing the bad debts, allowing provision for bad debts. Bad debts, provision for bad debts, both are allowed. Now, some years after that, the AO opened 147 on some other matter, not on bad debts and provision for bad, some other matters. Now, few years after that, the AO wants to revise the order of the CIT wants to revise the order of the AO, and for that, and he wants to revise what? He wants to revise bad debts, provision for bad debts. So, from where the 2 years time limit will be counted. So the court said that the 2 years time limit will be counted from the original order, because the AO wants to, the CIT wants to revise the matter which is there in the original order. The CIT does not want to revise the matter which is there in 147. Again, I'll say, originally in 143 subsection 3, the AO passed an order allowing you certain bad debts, provision for bad debts, because it's a banking company. Now, few years after that, 147 was opened on some other matter, not on bad debts and provision for bad debt. Now, few years after that, CIT wants to revise the order in which there was a bad debts and provision for bad debts. So, the 2 years time limit has to be counted from the original order and not from the 147 order. This is what it has been written over here. Okay. Now, coming to section 264. 264 is opposite of 263. Here, the CIT will revise an order which is prejudicial to the interest of assessee. Okay. But here and here, the CIT can on its own motion can also revise, and assessee can also make an application. But in the previous section, assessee cannot make application, only CIT has to revise on its own. Okay. Now, there are some important points which has to be kept in mind. The law says that once an order is revised under 263, then 264 is not possible. It means if your order was earlier subject to 263, then 264 is not possible, but the converse is possible. It means after 263, 264 is not possible. But after 264, 263 is possible. You have to be very careful about it. This is known as doctrine of complete merger. So once 263 is applied to an order, then the entire order cannot be touched under 264. Okay. But once 264 is touched, you can touch 263. There is no harm in that. Now, here also the CIT will or revise the order of AO. Here also the intimation, deemed intimation cannot be revised. Here also, if the CIT wants, it can direct the fresh assessment to the AO, and AO will do the fresh assessment as per the directions of the CIT. So this power is not there with CIT appeal. It is there with ITAT, CIT under 263 and CIT under 260. Now, what is the time limit? Now, there are 3 time limits over here. If the CIT wants to suo motu revise the order, then it has to revise the order within 1 year from the date of passing of the original order. So, within 1 year, if the CIT wants to suo motu revise the order, within 1 year from the date of passing of order. Okay, passing of order. Now, if the assessee wants to make an application, then the assessee has to make an application within 1 year from the date of communication. Communication means the date on which assessee received the order. Okay. Now, if there is a sufficient cost, it can be extended even beyond 1 year. Now, once you make an application, then CIT will revise the order within how much time? Once you make an application, then CIT will revise the order within 1 year from the end of the financial in which the application is made by the assessee. So, here there are 3 time limits. If you see, all of them are 1 year, but all of them are different. This is 1 year from the date of passing. This is 1 year from the date of communication, means the date on which you receive the order. And this is 1 year from the end of the financial year in which the application is made by the assessee. So, all of them are absolutely different from each other. Okay. So, don't make assumption that all of them are 1 year, 1 year, 1 year. It's not like that. One is from date of passing, one is from date of communication, and one is from the end of the financial year. Be very careful. What are the circumstances under which 264 is not possible? First of all, if you have appealed on any matter, suppose there are 100 matters in your order of AO, and if you have appealed on even one matter, 264 door is closed for you. 264 cannot be touched even if you have appealed for a single matter. So this is known as doctrine of complete merger. Even if you have appealed on a single matter, you cannot go for 264. Second, unless and until the time limit for appeal is not expired. Suppose the time limit for appeal is how much? CIT appeal is 30 days. So you cannot go for CIT under 264 till that time is expired. It means you can go only after 30 days. Till the time the expiry of the appeal time is not completed, you cannot go for revision under 264. Sir, if I want to go, then you have to give an undertaking to the department that we are not going to appeal later on. So if you want to go within 30 days of the expiry of the time limit, you can go for revisionary proceedings, but you have to give an application, that you have to give an affidavit, you have to give an undertaking that I am not going to appeal later on. So by default, after 30 days, you are free to go. Within 30 days, if you want to go, you have to give an affidavit, give an undertaking that I am not going to appeal. So, sir, can I file an appeal against the order of CIT under 264? No, this order is not appealable. But if you want to still file an appeal, you can go to High Court and file a writ petition. Writ petition is allowed, but appeal is not possible. This is the first order under the income tax law so far which is not appealable. Apart from this, whatever orders we have learned so far, everything is appealable. 143 appealable, 144 appealable, 147 appealable, 154 appealable, 250, that is CIT appeal order, appealable, 263 appealable, 263. After that, 254 ITAT order is also appealable to High Court. But only this order so far, 264, is not appealable. Sir, what if the CIT makes an apparent mistake? Yes, definitely he can rectify under section 154. There is no harm. Okay. Now there are some similarities and differences between the two. What is the similarity between the two? Both are revised by commissioners. Both are order of AO. In both suo motu they can revise. In both they can cancel and direct the AO fresh assessment. Both can be rectified under 154. What is the differences? 263 prejudicial to revenue. 264 prejudicial to assessee. In 263, if the order is passed, then you can file an appeal to ITAT. In 264, appeal is not possible, but you can file a writ petition. In 263, doctrine of partial merger. In 264, doctrine of complete merger. 263 is possible after 264, but 264 is not possible once 263 is touched. Then the time limit of 2 years, and here there are 3 time limits. All of them are looking 1 year, but not 1 year from the same time. They are different from different period. Then last but not least, the department has said that the CIT appeal, the ITAT, the revisionary proceeding, all of them, we are going to do what? We are going to be doing faceless, and faceless. That's it. Okay. Now, the next chapter is the compilation of what we have done so far. So, let's see that we have done all the time limits, almost all. Some of the time limits we have not done, we will do here. Okay. Like, what is the time limit to file a income tax return under 139(1)? 31st July for some people, 31st October for some people, 30th November. What is the time limit for filing a loss return? Same as above, because loss return has to be filed on time. What is the time limit to file a revised return and a belated return? Same, till 31st December or before completion of assessment, whichever is earlier. What is the time limit to file defective return? Within 15 days or as extended by the AO. What is the time limit to file a return as per 142(1)(1), where the AO will tell you to file the return? It will be specified in the notice. What is the time limit to give a special audit report? It will be mentioned in the notice, plus extension. Along with extension, total 180 days. It should not exceed. What is the time limit for giving a reference for valuation officer? Valuation officer will give a report within 6 months on the end of the month in which the reference was made to the valuation officer. What is the time limit for intimation under 143(1)? Intimation has to be sent within 9 months on the end of the financial year in which the ROI was furnished. What is the time limit for scrutiny notice under 143(2)? Scrutiny notice has to be served within 3 months on the end of the financial year in which the ROI was filed. And what is the time limit to complete the assessment under 143(3)? It is 9 months on the end of relevant AY, and if it is a case of transfer pricing officer, if the matter is referred to TPO, then 12 months extra, that is 9 plus 12, that is 21 months on the end of relevant AY. 144, that is best judgment assessment. What is the time limit for show cause notice? It will be mentioned in the show cause notice. What is the time limit for assessment? It is same as the above. You can check it above. Okay. In 147, there were multiple time limits. First, 148, notice will come to you. You will be asked to file an ROI. Within how many days you will file an ROI? It will be mentioned in the notice within how many days I am supposed to file an ROI. Now, for how many years they can send you a notice? They can send you notice for 3 years in some cases and 10 years in some cases, where the escaped income is greater than 50 lakhs rupees and greater than and equal to 50 lakhs rupees, and it is represented in the form of an asset, in the form of an expenditure, in the form of entries in the books of accounts. Here also, what is the time limit to pass an assessment under 147? The time limit to pass an assessment under 147 is 12 months on the end of the financial year in which the order and in which the notice under 148 is served, plus it is if it is a case referred to TPO, then 12 months extra, then that means it will be 24 months. What is the time limit for rectification under 154? That I've already told you, 4 years when the suo motu rectification, and when the SSC makes an application, they have to rectify within 6 months. What is the time limit for revision? That we have just seen right now. You can check it. For 263, there is only one time limit, and for 264, there are 3 time limits. Check it once. Okay. So let's move ahead with the next part. Now the profit link deductions we are going to see one by one. There are around 6 to 7 profit link deductions. We have to see one by one all of them. The first one is ATIB. In this deduction, in all these deductions, you need to understand 3 things. What are the nature of business to whom this deduction is available? What is the percentage of deduction which is available, and for how many years that deduction is available to the assessee? Okay. So now the first one, ATIB, it is available to industrial undertaking. Industrial undertaking means the assessee should be engaged in manufacturing, and there is one condition over here that you should begin manufacturing up to 31st March 2004, and that is the reason these provisions are all what? Most of them are sunset provisions, means most of them are going to be removed one by one over the years. Okay. Now the first business over here is industrial undertaking, and your business should commence before 2004. It is around 18 years back we are talking about. So now industrial undertaking means what? Industrial undertaking means you should be a manufacturer, and here also there is a condition for industrial undertaking, that if you are an industrial undertaking and you do business with the aid of power, then you should have at least 10 workers, and you do business without the aid of power, then you should have at least 20 or more workers. So with the aid of power, at least 10 workers; without the aid of power, at least 20 workers has to be there in your business. Then the second business is housing project, construction and building housing project. Third one is a commercial production or refining of mineral oil at any part in India. Then the business of handling, storage and transportation of food grains. Then the business of processing, preservation, packaging of fruits, vegetables, meat or meat products, poultry, marine, dairy products. And last but not least, you have to make a hospital of at least 100 beds in anywhere in India, excluding certain areas which the government has notified to be excluded. Okay. So if you are engaged in these businesses, we will give you 100% deduction for the first 5 years, and for the next 5 years it is 25% profits will be deductible under chapter 6A. Remember, these are deductions under chapter 6A. These are not exemptions. So 100% will be deductible for first 5 years. For the next 5 years, 25%. And if you are a company, for the next 5 years, it is 30%. Check it once. Now next, there is a Supreme Court, there is a Delhi High Court judgment in the case of Praveen Soni, which says that if suppose the assessee has started the production in the current year, okay, now the assessee has not claimed the deduction in the first year, second year and third year. Can the assessee start to claim deduction from the fourth year? The court has said that it is nowhere mentioned that you should claim deduction from the first year. If you have started business in the first year and for the first 3 years you have not claimed the deduction, you can claim the deduction from the fourth year. No harm in that. From the 4th till 10th year you can claim deduction, subject to the conditions which are mentioned in the law. You have to fulfill that. Okay. You can check it over here. So you can claim the deduction in short for the remaining 7 years, whatever is the leftover period. You have to fulfill the conditions mentioned in the law. Okay. Now next. ATIA. What does ATIA says that? ATIA has three businesses. First business is you should be engaged in telecommunication and internet services, but it should commence between this period, that is 1995 to 2005. Again, it's a sunset provision, not much relevant in today's time. Or you should develop or operate or maintain a SEZ industrial park or SEZ notified by central government. Or you should be doing what? Generation or distribution of power in India. You should be engaged in any of the three business. Then your 100% profits will be exempt, will be deductible. Sorry if I say exempt, I'm really sorry for that. These are not exemptions, these are deductions. Then your 100% profits will be deductible for 10 years. And in case of telecommunication, the benefit is slightly lesser. In case of telecommunication, for first 5 years it is 100%, and for the next 5 years it is 30%. Okay, but apart from that, for rest of the business it is 100% for 10 years. Next deduction is ATIC, which is for two states, that is Himachal Pradesh and Uttaranchal. If you go to Himachal Pradesh and begin manufacturing in Himachal Pradesh or Uttaranchal before 2012, or if you have already there in Himachal Pradesh and you substantially make an expansion, substantial expansion is made in the state of Himachal Pradesh and Uttaranchal. Sir, what do I mean by substantial expansion? Substantial expansion means there has to be increase in your plant and machinery by at least 50% of the book value as compared to last year. Suppose your book value of plant and machinery in the last year was 100 crore. So in the current year it has to be at least 150 crore. Then we can consider as a substantial expansion. So what are you supposed to do? You have to begin manufacturing of any article or thing in the state of Himachal Pradesh and Arunachal, in the state of Himachal Pradesh and Uttaranchal, or if you have already part of that state, you have to do substantial expansion. We will give you benefit which is there in the ATIB also. 10 years, first 5 years 100%, next 5 years 25%, and if you are a company, then for the next 5 years it is 30% benefit, just like the first section which was there. Okay. Next. ATID is for certain hotels, convention centers, etc. If you start a hotel in specified areas between 1/4/2007 to 31st March 2010, 31st July 2010, and it has to be at least a 2-star hotel, 2-star or above category. So from 2007 to 2010, if you started a hotel in certain specified areas, then you are eligible for this deduction. Similarly, in column number 3 also, if you start a hotel in World Heritage Site between 2008 to 2013, there were around 22 districts which were covered by the government. So then also you will be getting the benefit under this section. Then in the middle, if you start with a convention center like exhibition halls, etc., all these are like exhibition hall, conference hall, these are called as convention centers. Between this period from 1/1/2007 to 31st July 2010, then also you will be eligible for a deduction under ATID. So in ATID, you have to first open certain hotels in specified areas, at least 2-star hotel between these 3 years, then convention center between these 3 years, and then hotel in World Heritage Sites between these 5 years. You'll be eligible for 5 years deduction, 100% deduction for 5 years. You can see over here. Next. ATIE is for certain northeastern states like Arunachal Pradesh, Assam, Manipur, Meghalaya, Sikkim, Tripura, Mizoram, Nagaland. These are certain northeastern states to whom the government has given the benefit. If you go to northeastern states and manufacture any article or thing, other than, don't manufacture these things. Don't manufacture tobacco substitute, pan masala, plastic carry bag. These are ineligible goods. Or if you are already part of these states, you are already there in these states, you are already manufacturing in these states, then you have to do substantial expansion. Substantial expansion means the same thing which you have seen in the previous section. Okay. Or if you go to these states and open a hotel not below 2-star, or adventure or leisure sports are including ropeway, or a nursing home of at least 25 beds, or a old age home, or a vocational training center, or running an information technology training center, or manufacturing of information technology hardwares, or biotechnology, then we will give you 100% deduction for 10 years back to back. These are all consecutive deductions. You have to claim deductions back to back over the 10 years immediately, one after another. There cannot be a gap between them. Okay. Next benefit is only available to certain eligible startups, and ATIAC is a very important section for your exam. Now this section is eligible only for a company and LLP. It is not available to everyone. That to your company and LLP should be incorporated between April 2016 to March 2023. That is before 1st April 2023. It has to be incorporated, and your turnover does not exceed 100 crore in any of the previous year. It means your turnover should be up to 100 crore rupees. Plus you should hold a valid certificate that you are doing an eligible startup, and this certificate will be given to you by Interministerial Board of Certification. Plus your company or NLP should be absolutely new. It should not be formed by splitting up or reconstruction of an already existing business. Plus you should not use second-hand plant and machinery, but second-hand plant and machinery up to 20% of total value is allowed, and imported second-hand plant and machinery is also allowed if depreciation was not claimed earlier. These are the 2 points which are same as what 35 AD, which was there in 35 AD also, if you remember that. Okay. Now if you fulfill these conditions, your 100% profits will be deductible for 3 consecutive years. And which 3 consecutive years? you can select any 3 consecutive years out of the first 10 years. Out of the first 10 years, you can select 1, 2, 3, 2, 3, 4, 3, 4, 5, 4, 5, 6, 5, 6, 7, 6, 7, 8, 7, 8, 9, 8, 9, 10. You can select any 3 consecutive years out of the first 10 years which you want to claim. But you have to select the 3 consecutive years. There cannot be gap between these 3 years. Okay. Now, then there are certain procedural points which you have to fulfill. You have to get your books of accounts audited, audit report has to be there. You have to file your ROI on time, etc., etc. These are certain procedural points which you have to fulfill. Next is for what? Builders, housing project builders. This section is available to everyone, ATI be it given to certain housing projects. This section is available to everyone, individual, HUF, firm, LLP, etc., etc., etc. The assessee has to do what? Assessee has to develop and build a housing project. What kind of housing project? Predominantly residential units. Predominantly residential units means what? 97% of the build-up area should be for residential purpose, and 3% of the build-up areas can be for shop and certain commercial purpose. 3% commercial will be allowed, 97% has to be for residential purpose. Next, the project should be approved between June 2016 to March 2022. The project has to be approved between these 6 years, June 2016 to March 2022. Plus, once the project is approved, it has to be completed within 5 years from the date of first approval. It has to be completed within 5 years from the date of first approval. Plus, suppose there are a project in which a building is made. So in that project, if the builder has allotted me one house, then he cannot allot second house in my name. He cannot allot second house in my wife name also. He cannot allot second house in the name of my minor child also. Once a house is given to an individual, no other house should be given to same individual, to the spouse of the individual and the minor children also. Such houses should not be given. Next. What should be the size of the plot? The size of the plot should be given by the law. What should be the size of the flat? The size of the flat should also be given by the law. And what should be the height of the building? The height of the building, which is known as FSI or FAR, floor space index or floor area ratio, should also be given by the department. So therefore, what should be the size of the plot? That depends upon the cities. For that purpose, the government has divided all the cities into 2 categories: certain big metro cities and other cities. Big metro cities includes what? Chennai, Delhi, Kolkata, Bangalore, Hyderabad and Mumbai are categorized as big metro cities, and any other place will cover rest of the country. So if you are in big metro cities, your plot of the land should not be less than 1000 square meter. If you are in small metro cities or other cities or villages, your plot of the land should not be less than 2000 square meter. Then in big metro city, your size of the house should not be more than 60 square meter. Maximum size of the house should be 60 square meter. But in other cities, it can be 90 square meter. The floor area ratio. In the big metro cities, you should utilize at least 90% of the height which is given to you. Suppose the builder has told you, suppose the government has told you that you can make a 100-meter building. So you should make at least 90-meter building in the big cities. And in the small cities, you should make at least 80% of the building. That is at least 80-meter building out of the 100-meter if it is allowed to you. Okay. Now, there are certain procedural points which you have to keep it in mind. The assessee should maintain certain separate books of accounts. The stamp duty value of the property should not exceed 45 lakh rupees. Be very careful. Then only this benefit is available. The stamp duty value of the property should not exceed 45 lakh rupees. Now, there is one Bombay High Court judgment which says that suppose if there are certain disallowances which are made by the assessing officer under section 40A 1A or 43B, will I get the deduction of that also? The answer is yes. If there are certain disallowances which are made as a part of this section, you can get the deduction of that also, because the disallowances which are made are also part of PGBP, and you get deduction under chapter 6A of the entire PGBP income if you fulfill all the conditions. So whatever disallowances are made and because of which the GTI is increased, so that disallowance will also be subject to deduction under chapter 6A. If all the above conditions are fulfilled, then 100% of the profits of the builder will be subject to deduction under ATIBA. Now, as I've told you earlier also on the previous page, the project has to be completed within 5 years. If you do not complete the project within 5 years, so whatever deduction you have claimed earlier will be deemed to be business income of the assessee in the year in which the period in which completion so expires. So if you don't complete within 5 years, so in the 5th year, all the deductions which you have taken in the first, second, third, fourth year will become deemed income of the 5th year. Check it please. Now. Apart from this, the government has also introduced one more point, but they have not put any rules for that. So this project was for what? Affordable housing project which the builder will sell. Now the government has said that we will also give deduction to those builders who will make affordable housing project for the purpose of rental. So now the project was for the purpose of sale. So now if the builder makes an affordable housing project for the purpose of rental purpose, we will give you deduction in that case also. Check it over here. So for that purpose, the government is going to notify certain notifications which has not yet come in your syllabus. Okay. Now, one last section over here is with respect to producer company. Producer company is defined under what? Is defined under 581A subsection 1 of Companies Act 1956. Producer company is not defined in 2013 Companies Act. It is defined in 1956. So if a producer company fulfills certain conditions, that is, if it is a producer company as per the Companies Act 1956 and the turnover is less than 100 crore and the gross total income includes income from eligible business. Sir, eligible business means what? Eligible business means the same same businesses which were mentioned under ATP for cooperative society. If you remember, marketing of the agriculture produce grown by the members, same, it was mentioned in cooperative society also. Purchase of agriculture implements, same, it was mentioned in a cooperative society also. Processing of agriculture produce, same, it was mentioned in cooperative society also. So if a producer company is engaged in these businesses, then they are eligible for 100% profits of deduction under chapter 6A for these 5 years from AY 1920 to AY 24-25. Apart from this, they will also be eligible for deductions under 80C to 80U. They will get 80C to 80U also, and they will also get the deduction of 80PA for these 5 years. The condition is the assessee should be a producer company, the turnover should not exceed 100 crore rupees, and they should be engaged in the eligible business. Okay, so this is what your profit link deduction is all about. Just check it once and then we'll go ahead with the next part. So after this, let's go ahead with the next part, which is a very important topic for your exam, that is minimum alternate tax, which says that if you are a company, then you have to make two computation of tax. One is the normal computation of tax and one is the MAT calculation of tax, which is 15% of your book profit. Okay, so you have to make two calculations. So first of all, let's talk about the normal tax rate. What is the normal tax rate applicable to companies? Okay, the normal tax rate applicable to the companies are as follows. If you're a domestic company and if your turnover of last to last year is up to 400 crore, then 25% tax. If your turnover is greater than 400 crore, then it is 30% tax. And if you are a foreign company, then it is always 40% tax. Okay. What about surcharge? Now, the surcharge is up to 1 crore total income, there is no surcharge. If the total income is greater than 1 crore but up to 10 crore, then for domestic company it is 7% and foreign company it is 2%. And if the total income is greater than 10 crore also, then for domestic company it is higher surcharge of 12% and for foreign company it is a lower surcharge of 5%. Okay. Health and education cess of 4% will always be applicable on your tax rate. Now comes the MAT calculation. This was the tax rate for normal provision. What is the tax calculation for MAT? For MAT, for everyone it is 15%. Whether it is a domestic company or foreign company, less than 400 crore, more than 400 crore, equal to 400 crore, for everyone it is 15% tax rate. Plus surcharge and cess will also be applicable if at the same rate. Surcharge and cess will be applicable at the same rate if instead of now seeing the total income, you have to see what? The book profit. If the book profit is more than 1 crore and up to 10 crore, then 7% and 5%, 7% and 2%. And if the book profit is more than 10 crore, then it will be 12% and 5%. Okay, this is how you are going to compute the tax rates now. Now, is MAT applicable to every company? Yes, MAT is applicable to every company. Whether Companies Act is applicable, then also is applicable. If Companies Act is not applicable, if some other act is applicable to a company, like a Banking Act, Insurance Act, Electricity Act, then also MAT is applicable. Okay. So in MAT, what happens is you pay tax at the rate of 15% of book profit. Now, book profit has to be computed as per the P&L account, as per the accounting P&L account. So what shall be the accounting P&L? Which accounting P&L? Shall I make a separate accounting P&L, or I can use the same accounting P&L which I am putting forth in front of the AGM, in front of the shareholders in the AGM? So the law says that you have to put the same accounting P&L which you have put forth in front of the shareholders in AGM. You have to follow the same accounting policy, same accounting standard, same depreciation policy, same depreciation rate. Your P&L should be the same as you put forth in front of the shareholders in the AGM. Okay. Next, is MAT applicable to foreign companies also? Yes, MAT is applicable to foreign companies also. In some cases, MAT is not applicable to foreign company. That we'll see later in this topic itself. But by default, MAT is applicable to a foreign company also. Now, suppose there is a foreign company who is following a calendar year and we are following financial year in India. Then how the P&L will be made? So the government says that in that case, the foreign company has to readjust its P&L and make the P&L as per the financial year. So if the foreign company is following the calendar year of Jan to December, then it has to make a revisit. It has to revise its P&L and make from April to March accordingly, and has to follow the provisions of MAT. There is no excuse from following the provisions of MAT for anyone. Everybody has to follow it. Okay. Now, how to compute book profit? Because MAT is a calculation of 15% tax on book profit. So how to compute book profit? Book profit is nothing but net profit as per your P&L account plus add few items, less few items, you will get the book profit. So first of all, we are going to see all the additions. Okay. What is the first thing that has to be added in MAT? At the same time, side by side, I will also tell you the treatment of that item in the normal provision also. Income tax. Income tax will be added back in MAT. In the normal provision also, it will be added back. Income tax includes which all things? It includes dividend distribution tax. Dividend distribution tax now does not have any relevance, but still it is written in the law, so I have written it. So dividend distribution tax will be added in MAT. In normal provision also it will be added back. Next, interest on income tax. Interest on income tax will be added back in MAT, and in normal provision also it will be added back. Next, surcharge and health and education cess will be added back in MAT and also added back in the normal provision. Next, what about wealth tax? Wealth tax will not be added back in MAT because that is not mentioned over here. But in normal provision, wealth tax will also be added back. What about penalties? Penalties will not be added back in MAT, but in normal provision, that also should be added back if the penalty is penal in nature. If the penalty is compensatory in nature, then it should not be added back in MAT. Then it should not be added back in normal provision. So wealth tax and penalty, these are the two items which are not added back in MAT, but in normal provision it has to be added back. Be very careful. Now the next one is transfer to any reserve. If you remove any profit from reserve and debit to PNL and transfer that amount to reserve, you have to add it back in MAT. In normal provision also you have to add back, except one point is there, which is where you don't have to add back in the normal provision, that is 3618, because in 3618 transfer to special reserve is a special deduction which is allowed to certain assessees. Okay, next, provision for uncertain liability, add in MAT, add in normal provision. Provision for loss of subsidiary, add in MAT, add in normal provision. Amount paid of dividend paid or proposed, add in MAT, add in normal provision. These 3 points are absolutely same, as this is also same almost. These 4 points are absolutely same in MAT also, in normal provision also. In MAT also you have to add it back, in normal provision also you have to add it back. Okay, now this point has to be read along with point number 2 of deletion. Now what does this point say? This point says that if there is any expense in relation to section 10 income, section 11 income, section 12 income, what are these incomes? Section 10 income is an exempt income. Section 11 and 12 is also exempt income with respect to a trust, charitable trust, religious trust. So if you incur any expense in relation to section 10, add back. Similarly, if there is any income in relation to section 10, if there is any income in relation to section 10, you have to reduce it back. You have to reduce it back. You have to reduce it back. This is the reduction part. So if there is a PNL, and on the debit side, if there is any section 10 expense, section 11 expense, section 12 expense, on the credit side, if there is any section 10 income, section 11 income, section 12 income, you have to add back the expense and you have to reduce the income. It means the section 10 income and section 10 expenditures are not liable for MAT. So for example, if I am a company and if I am earning agriculture income, reduce. If I am a company, I am getting some share of profit from a partnership firm, reduce. But if I am a company and if I am getting some share of profit from AOP BOI, that cannot be reduced here. Why? Because the share of profit from AOP BOI is not exempt in section 10. It is exempt in section 86. And therefore, for share of profit from AOP BOI, the law has made a separate provision over here, as you can see over here. So if you receive any share of profit from AOP BOI, that is also not liable to MAT. For that, the government has made a separate clause, separate clause, separate clause. So the share of profit from partnership firm, reduce. Share of profit from AOP BOI also reduce, because there is a separate clause for that. Sir, what about the deductions under 10AA, ATIA, ATIB, ATIC, ATID? If there is an expense in relation to these deductions, let it be on the debit side of PNL, let it be on the credit side of PNL, let it bear the brunt of MAT. These incomes will be subject to MAT. These profit link deductions will be subject to MAT in the provisions of MAT. So let it be on the debit side and let it be on the credit side, let it be part of PNL, let it bear the burden of 18%, 15%, whatever is the MAT rate. But in the normal provision, you will reduce it from the GTI. Gross total income, you will reduce, because these deductions are from chapter 6A. This is a very important point which has to be kept in mind. Okay. Next, expenditure relatable to income by way of royalty of patent taxable under 115 BBF. So what is 115 BBF? So for that, we need to see 115 BBF separately. There is a section over here, 115 BBF, which is only applicable to residents, and resident. It is not applicable to others. If there is a resident who is developing some product, okay, and he is making patent of that product, and then he is selling the patent and earning some money, and the patent is developed and registered in India. So if the assessee is a resident and he is developing some patent, he is selling the patent, he is earning some royalty out of it, that royalty will be subject to 10% flat tax, but on gross basis. So this is an option. 115 BBF is an option. If you want to come, you can come. If you don't want to come, don't come. So here the government is giving you an option of paying tax flat at 10% of your gross royalty. Do not ask for any deduction of any expenses or any allowances. Don't ask for anything. So how can I opt for this? You have to opt this on or before the filing of return of income. You have to opt this before the due date of filing of return. Okay. So if I don't want to opt this, don't opt. Then you follow the normal provisions, pay tax at per 25 or 30% tax rate, and then you can claim all the expenses. But if you come over here, flat 10% tax, no deduction of any expenses or allowances. Okay, but there is one restriction over here. Once you follow this particular provision, you have to follow this provision for the next 5 years. Now, in the next 5 years, you cannot say that I don't want to follow this. You cannot say that. So, in the next 5 years, if you say that I don't want to follow this, then the government will not allow you to come over here again for the another 5 years. So, this is just like 44AD if you remember. Do you remember that 44AD provisions? Exactly similar to that provision it is. Now, there is one of the conditions to come over here is your expenditure of research and development should be done 75% in India. So, 75% of research and development should be done in India. Now, why this provision is brought? This provision is brought by Finance Act 2016. Why? To encourage indigenous research and development in India, so that there is a great amount of research and development in India. And at the same time, the government said that there will not be any kind of MAT liability on this particular income. If you go for this section, there will not be any MAT. your MAT provisions will be exempted. It means if there is an expense in relation to 115 BBF royalty, that has to be added back, and if there is an income in relation to 115 BBF royalty, that has to be reduced. You have to nullify the effect of these expenses and these incomes from the book profit, and there will not be any MAT on this income. Check it, please. Okay. Next. Let's go ahead with the next point. What is the next point? Next point is depreciation. So you have to add back depreciation under MAT. And in normal provision also you add back depreciation and then you reduce the depreciation as per section 32 under the normal provision. In MAT also you have to add back depreciation and then you have to reduce the depreciation which is other than the revaluation portion. Check over here. So suppose if your depreciation is, suppose if the cost of the asset is 100 rupees and the rate of depreciation is 10%. And if you revalue the asset by 200 rupees, so the value of the asset is now 300. So depreciation will come to 30 rupees. So add back 30 and then reduce other than revaluation. It means reduce depreciation on only 100 rupees. It means reduce depreciation of 10 rupees. So add back 30 and then reduce 10. So this is what this point has to say. Is it clear? Next, you have to add back deferred tax asset and you have to reduce the deferred tax liability if it is debited and credited in the P&L account. In normal provision also you have to do the same thing. Next, you have to add back diminution in the value of asset. Now, what do I mean by the term diminution in the value of asset? Diminution in the value of asset means reduction in the value of asset. Example, provision for bad debts. In normal provision also you have to add back provision for bad debts. Provision for impairment of asset. In normal provision also you have to add back provision for impairment of assets. So all these things are added back in the normal provision also. So but provision for bad debts are allowed to certain people in normal provision, like for banking and NBFCs and certain other institutions. It is allowed on a presumptive basis. That is 8.5% of total income, 5% of total income. But in MAT it will be added back to everyone. Okay. Next. Amount standing in the revaluation reserve relating to revalued asset on disposal of asset. What do I mean by this? Suppose you bought an asset for 100 rupees and then you sold that asset for 2000 rupees. How much is the profit? 1900. 1900 will be liable for MAT. So what people do to avoid this MAT on 1900 rupees, what they do, 100 rupees asset, they revalue by 1900. So if I revalue the 100 rupee asset by 1900, the value of the asset in the balance sheet will look at 2000 and then I will sell at 2000, there will be no profit or loss. So the government said that if you revalue an asset and then you sell it, if you revalue an asset and then you sell it, then whatever is the revaluation on that asset sold, that will be added to the book profit. So 100 rupees asset I revalued by 1900. So the value of the asset is 2000. Now if I sell that asset at whatever price, the 1900 rupees should be added back to the book profit. That is what this point has to say. Check please. Is it clear? Next one. Now let's come to the deletion point. Deletion first point is what? First point deletion is the ripple effect of what we have done earlier. So first of all, suppose if I am transferring some profit from P&L to reserve, then I have to add back that much profit. So if I am transferring some profit to reserve, so say 100 rupees I have transferred to reserve, then I have to add it back as per clause number 2, which is mentioned behind. This is the point which is mentioned over here. So at the same time, the ripple effect of that, the opposite effect of that. Now if I take out something from reserve and credit back to P&L, I have to reduce from the P&L also. So when something was going from P&L to reserve, I have to add it back. So if something is coming back to P&L from reserve, then I have to reduce it back. But this is only allowed if the book profit was increased earlier. What do I mean by this? I cannot explain much about this because there requires a lot of examples to explain over here. But only keep in mind one thing in the exam. You can reduce this from the P&L book profit only if it is written in the bracket that book profit was increased in the earlier years. If it is written in the bracket that book profit was increased in earlier years, you can reduce from book profit. If it is written in the book profit, if it is written in the bracket that book profit was not increased in the earlier year, then you don't have to reduce this. Do not reduce this. You have to use these two. Keep this thing in mind, what I have said you. So if book profit was increased earlier, then you can reduce it. If book profit was not increased earlier, do not reduce it. This is what this point has to say. Next. Next one is also very, very important point. This point we have already done. This point we have already done. Let's do the next point. Cost of asset 100 rupees. Revaluing asset by 200. So the value of the asset is 300. Now the rate of depreciation is 10%. Suppose, then what will happen? As I have already told you, you have to add back depreciation and then you have to reduce the depreciation which is other than revaluation. Other than revaluation is only 10 rupees. Okay. Now what I am doing is, this 200 rupees is there in the balance sheet. Now out of this balance sheet, I am transferring some amount to P&L. Okay, say I am transferring 50 rupees to P&L. I am crediting. Now there is in the balance sheet, there is a balance of 200 in revaluation reserve now. So out of that revaluation reserve, suppose if I remove some amount and I credit that to P&L, can I reduce that? The government says that yes, you can reduce, but only to the extent of depreciation on revaluation. So how much is the depreciation on revaluation? So if you remove anything from revaluation reserve and credit to P&L, if you remove anything from revaluation reserve and credit to P&L, you can reduce it from book profit, but only to the extent of revaluation reserve. So how much is the depreciation on revaluation? The depreciation on revaluation is only 20 rupees. You can check it. So here, how much I am removing from the revaluation reserve? 50 rupees. Where I am crediting to P&L account. I can reduce only to the extent of 20 rupees. So if I remove 10 rupees from revaluation reserve and credit to P&L, then I can remove entire 10 rupees. So you cannot reduce more than 20 rupees. Be careful about that. That is something which the law has to say over here. Okay. Next, What happens with brought forward loss and UAD under the normal provision? Under the normal provision of the income tax law, the brought forward loss and UAD is allowed to be carried forward and set off as per the provisions of section 72, 73 or section 32. Both are allowed to be carried forward and set off. Both under the normal provision, both are allowed. But under book profit, you are supposed to take the brought forward loss or unabsorbed depreciation as per the accounts first of all, not as per tax, and that too whichever is less. You cannot take both. You cannot take both. You cannot take both. So if either of them is nil, if this is nil, then answer will be 0. If this is nil, then answer will be 0. If either of the 2 points are 0, then you are not going to get any set off of brought forward loss or UAD under the book profit. But there are 2 categories of assessee to whom the government has given the benefit of taking both the benefits. One, if your company is getting insolvent and you have gone to insolvency and bankruptcy code, you have made an application to insolvency and bankruptcy code for revival of your company, then the government is going to give you both aggregate of UAD also and loss also. This is the benefit which is given to certain companies who are getting insolvent and they are making an application to insolvency and bankruptcy code for revival. So for them, both the benefits are available. There is one more company for which both the benefits are available, which we'll see in the later on in the chapter of set off and carry forward in section 79. So whenever that particular topic will come, I'll be addressing that. Okay. Next. Profit of sick industrial company. Till the time your company is a sick company, you are not liable to pay any kind of MAT. Your MAT liability will be 0. So when a company is considered to be a sick company, a company is considered to be a sick company when their accumulated losses is greater than their net worth. So if the accumulated losses of the company is greater than the net worth, then the company is considered to be a sick company. And if the company is considered to be a sick company, there is no liability of MAT till the time the company is not well. Okay. And last but not least, which I have already told you, that is no deferred tax. On deferred tax also, you are not liable to pay any MAT. You have to reduce that much deferred tax from your book profit. Okay. Next, what is next? This we have already done. That is no MAT on share of income from AOP VOI earned by the company. Okay. Now, the next point is very important, which is only applicable to foreign companies. So, next point which I am going to say is only applicable to foreign company. It is not applicable to domestic company. Now, if a foreign company who is liable for capital gain on securities, only capital gain on securities at a rate lower than 15%. So, if a capital gain chargeable in the hands of a foreign company is, say, it is lesser than 15%, then on that MAT will not be applicable. Like for example, on 112A long-term capital gains, MAT will not be applicable to foreign companies. To domestic company, it will be applicable. Okay. So if there is a liability at a lower than 15% rate, the normal provision tax rate is lower than 15%, then MAT will not be applicable. Similarly, if there is a foreign company who is earning some royalty, some fees for technical services, which is also lower than the 10% tax rate, generally it is which is lower than the 15% tax rate. Generally, these royalties and FTS are taxable under 115A at how much percentage? At 10%. Okay, so that royalty and FTS will also not be liable for what? MAT. Similarly, if there is a foreign company who is earning some interest from India, which is liable to tax at a lower than what? At a lower than 15% tax rate, like 194 LB, 194 LZ, etc. We have seen in the chapter of non-resident that in that section, the tax rates of certain interests are chargeable at 5%. So in that case also MAT will not be applicable. Similarly, if a foreign company is earning some dividend income, that is also liable for a tax rate which is lesser than what? Which is lesser than 15%, then that will also not be liable for MAT. So what is the reason for not putting MAT on these people? The first reason why the capital gain on securities are not liable for MAT, because we want the foreign companies to invest in Indian stock market. That is the reason we are relaxing their MAT. Why the foreign company are not liable for MAT on FTS and royalty? Because we want them to provide services to Indian company, the technical services and the advices which they give, we want them to give to India. Why the interest is not liable to MAT over here? Because we want that the foreign company should provide loans and money to the Indian entity to do business in India at a cheaper rate of interest. That is the reason we are relaxing the tax rate, and we are also relaxing them from what? Liability of MAT. Similarly, why we are not charging them MAT on dividend income? Because we want the foreign company to invest in Indian companies, domestic companies, and to put money in India, and that is the reason we are relaxing them from dividends. Okay, check it please. Now, next one. MAT is not applicable to certain businesses. Like if a life insurance business is covered under 115B, MAT is not applicable. Similarly, MAT is not applicable to certain alternative tax regime. We are going to learn later on, that is in 115BAA, 115BAB. These are alternative tax regime where the tax liability of the company is 15% in some case, 22% in some case. So on that income, MAT will not be applicable. Only the normal provision will be applicable on that income. Okay. Next. 115JAA, MAT credit. What is MAT credit? When you pay MAT liability more than the normal provision, that is known as MAT credit. Suppose this is 20 crore, this is 15 crore, then 5 crore is called as MAT credit. When the provision, then the tax as per the MAT, When the tax as per the MAT is more and the tax as per the normal provision is less, the difference between the two is called as MAT credit. When can I use that MAT credit? In the reverse situation you can use. When your normal provision tax is more than your 115 JB. Suppose normal provision tax is 12 crore and 115 JB tax is how much? 115 JB tax is 10 crore. So now to pay this normal provision tax of 12 crore, you can use the credit of 5 crore. So can I use the entire 5 crore? No, no, no. You can only use to the extent of these two. So therefore, out of this 5 crore, 2 crore you can use as a credit and 3 crore you have to pay from your pocket. So you cannot use the entire amount of credit. You can use only to the extent of the difference between the two. That much is allowed to be taken as a credit, and balance has to be paid from the pocket of the assessee. Okay. Next. There is an example to explain the 115 JB, 115 JAA credit method, how credit is taken, etc., etc. You can go through this example if you want. Okay. Next. There are certain High Court and Supreme Court judgments which we need to see one by one. First of all, does the assessing officer has the power to change the P&L? The assessing officer does not have the power to change the P&L in MAT. He only has the power to add or less the items which are mentioned in 115 JB. Apart from that, he cannot change the P&L account which is certified by chartered accountant, which is accepted by shareholder, which is accepted by the annual ROCs. So ROC has accepted that, everybody has accepted that. So that P&L account, that books of accounts cannot be reopened and changed by the assessing officer. He does not have the power to recompute the book profit. Okay, next. Is MAT applicable on the income which is exempt under 54EC? Suppose there is an assessee to save the capital gains, he has invested in long-term capital bonds. He has invested in some NHAI REC bonds. So is MAT applicable on that capital gains? The government, the High Court has said that no, MAT will not be applicable on that capital gains which is invested in 54EC. So that much capital gains will be exempt under MAT also, and in normal provision also it is exempted. So in normal provision also exempt, and in MAT also it will be exempt. Okay. Next, is the assessee liable for MAT? Is the assessee who is liable for MAT, is he liable for payment of interest in case he does not pay advance tax on time, etc., etc.? Definitely. Why not? If the assessee who is liable for MAT are not absolved from the liability, general liabilities have to be followed by everyone. An assessee who is liable for MAT has to file the return, has to pay the taxes on time, has to follow the deadlines of the advance tax, has to deduct the TDS, has to pay the TDS. In case of any default, the way other companies are penalized, the same way this company will also be penalized. Whether you are following MAT or whether you are not following MAT, it doesn't matter in that case. Okay. 115 BBF I've already addressed with you all. Next one I'll like to tell you, as I've told you at the beginning of the chapter, that whether MAT is applicable to foreign company. MAT is not applicable to foreign company in two circumstances. In two circumstances it is not applicable, otherwise it is applicable. First circumstance, the foreign company is of a country with which India has a DTAA. So foreign company is of a country with which India has a DTAA, and that company does not have a permanent establishment in India. So foreign company is of a country with which India has a DTAA, plus that company does not have a PE. Therefore, this company will not be liable for what? MAT. Will not be liable to MAT. For example, foreign company is of UK. Now India and UK has a DTAA. Now suppose UK company is doing some business over here, but they don't have a PE over here. They don't have a permanent establishment, so they will not be liable for MAT. So second case is for whom? Second case is for those people which country India does not have DTAA. So if India does not have a DTAA with a particular country, then when MAT is not applicable, then MAT is not applicable if the country with which India does not have a DTAA. This is the first condition, and the second condition is if that company is not liable for registration under any law in India. Check over here. If they are not liable for registration under any law in India, then there is no MAT. Okay. So if the foreign company is of a country with which India does not have a DTAA and that country is not liable for seeking registration under any provisions of the income tax law, then they are not liable for MAT. Check it please. Now, if your unit is located in an IFSC, International Financial Service Center, which is in Gujarat, and if your consideration is payable in foreign currency, then you will be liable for a MAT of a concessional rate of 9% instead of 15%. This rate is also there in AMT, and this concept of IFSC is spread out at multiple places under the entire income tax law. Be very careful about it. Now, there are certain procedural points. Every company who is following MAT has to furnish a report in Form 29B from a chartered accountant certifying that the book profit is computed properly on or before the specified date under 44AB. That is along with the tax audit. Along with the tax audit report, you have to give this report in Form number 29B that your books of account, your book profit has been computed properly, and it will be certified by a chartered accountant. Okay. Now, in case of life insurance business, the government has given them a special mechanism that life insurance business assessees will compute tax at the rate of 12.5% as per the normal provision, and they will not be liable for what? MAT. They will not be liable for MAT. Under normal provision, they will be liable for 12.5% tax, and under MAT, they will not be liable for MAT for life insurance business. What about non-life insurance business? Non-life insurance business will prepare P&L as per Insurance Act, and they will follow the rest of the income tax provisions. As you can see, they will follow all the deductions and disallowances, and they will provide diminution the value of investments. They will provide gain or loss. They will reserve for unexpired risk as prescribed shall be allowed. So this is something which is given under Rule 5 of the income tax rules, and it is also given in the first schedule of the the act, which is not a part of your syllabus. The first schedule is not given in detail. Otherwise, this computation is in great detail. So for life insurance business, 12.5%, no mat. For other than life insurance business, you have to follow the Insurance Companies Act, you have to follow Rule 5, you have to follow the first schedule, and you have to follow the income tax provisions which are given over here. Now, one last thing which I have did for you all is, as my regular batch and fast track batch student already knows, that I have made a summary for last day revision. That is what all things will be added in MAT and what all things will be added in normal provision. I have given a complete list. So this covers the entire MAT chapter except one point which we will be covering later on in separate chapter, that is MAT with Ind AS. Okay, so just go through it once and then we'll move ahead with the next part. So let's go ahead after this. So immediately after the MAT is completed, our duty is to understand what are the provisions of alternate minimum tax. And alternate minimum tax is covered in section 115 JC and it is applicable for other than companies. So for companies, MAT is applicable, and for other than companies, it is alternate minimum tax which is applicable. So for other than companies, what is the tax liability? It is higher of tax as per the normal provisions of income tax or 18.5% of adjusted total income. So you have to compute tax as per your normal provision and then you have to compute 18.5% of adjusted total income. So adjusted total income is what? Adjusted total income is nothing but addition of 3 items and deletion of 1 item. So what are the 3 items? You have to add back all the profit link deductions except ATP. Do not add back ATP. Apart from that, add back all the profit link deductions to the total income. Then you have to add back 10AA, then you have to add back 3580, and then you have to reduce what? The depreciation on the asset which are claimed as deduction under 3580. If it is a building, claim depreciation at the rate of 10%. If it is a plant and machinery, claim depreciation at the rate of 15%. Even additional depreciation can be claimed if the assessee is a manufacturer. Okay. So there are 3 additions which you have to make in total income and 1 deletion which you have to make. You will get adjusted total income. Now there is one amendment made by Finance Act 2022 that this 18.5% will become 15% for cooperative society. Check it over here. So for cooperative society, the tax rate of AMT is how much? 15%. And for everyone, including cooperative society, if the unit is located in IFSC, then the tax rate will be how much? 9% instead of 18.5% or 9% instead of 15% in case of cooperative society. Okay. Now, are we supposed to also add the payment link deduction? No, no, no. Payment link deduction should not be added back. Payment link deductions will be allowed in the same way the way it is allowed under the normal provisions. Now, is AMT applicable to every assessee? Yes, it is applicable to every assessee who are claiming either of these deductions. If you are claiming either of these deductions, AMT is applicable. But there is some relaxation given to individual HUF, AOP, BOI and artificial judicial person. So if you are an individual HUF, AOP, BOI and artificial judicial person, then AMT is not applicable unless and until your adjusted total income exceeds 20 lakh rupees. So for individual HUF, AOP, BOI, artificial jurisdictional person, AMT is applicable only if the adjusted total income exceeds 20 lakh rupees. Otherwise, it is not applicable. Okay. Secondly, for partnership firm and LLP, there is no such criteria. For partnership firm and LLP, the limit of 20 lakhs is not applicable. For them, AMT is always applicable. It is just that they should claim either of the 3 deductions which are mentioned above. Okay. Now, here also you have to follow the AMT credit concept the way we follow the concept of MAT credit. How, sir? It is in the same way that first, when AMT credit is available, when your AMT liability is more than your normal liability, then AMT credit is applicable. When you can use that credit, when your normal tax liability is more than your AMT, then you can use that tax liability. How much to be used? To the extent of the difference of the two. You cannot use completely, only to the extent of the difference of the normal and the AMT tax. You have to use only to the difference of the two. The balance has to be paid from the pocket, and it can be carried forward for how many years? It can be carried forward for 15 years. The way MAT credit was carried forward for 15 years, even AMT credit will be carried forward for how many years? For 15 years. Okay. Now, one very important point. Suppose in the current year AMT is applicable. So you have paid AMT and there is a credit. Now, suppose in the next year AMT is not applicable. Why, sir? Because you are not claiming any of the deductions mentioned above. So AMT is not applicable in the next year. So how will I use the credit? So the law says that in particular year, if AMT is not applicable, then also compute AMT, then also find out the difference. And just for the sake of taking the credit, you have to compute AMT. Even though in the next year AMT is not applicable, still you have to compute AMT, find out the credit and then use the credit. You are absolutely allowed to do that. Don't worry about it. Next. If a question in the exam is on partnership firm, LLP, AOP, BY, then always try to find out what AMT implication might be there. Okay. Now, assessee opting for 115 BAC and 115 BAD are not liable for AMT the way the assessee opting for 115 BAA and BAB were not liable for MAT. Same way here also there is no liability of AMT on these assessees. Last but not least, assessee who are opting for AMT has to fill a form in form 29C and prescribe form 29C and has to be certified by a chartered accountant that adjusted total income has been computed properly, and it has to be filed along with the tax audit. Okay, just check it once. This is a very simple topic but very important topic in the exam. Okay. Now let's move ahead with the big one, that is the topic of penalty. Now the first thing is there are a lot of penalties under the income tax law, and we will be learning a lot of penalties over the time. We have also learned some penalties earlier also, and later on also we are going to learn a lot of penalty. But today the first penalty that we are going to learn is the penalty under section 270A, which is penalty for underreporting or misreporting of income. That is the penalty for income which are escaped by the assessee. So on that, how much penalty will be imposed? So the first question which we need to answer is that who will impose penalty? A penalty can be imposed by AO or CIT appeal or CIT. These are the three income tax authority who has the power to impose penalty under 270A. Does ITAT has the power to impose penalty? ITAT does not have the power to impose penalty under the income tax law. ITAT cannot impose penalty. Now, how will they impose penalty? How will they initiate the proceeding? To initiate the proceeding, these authorities have to do what? Have to issue a show cause notice. The AO will issue show cause notice, the CIT appeal will issue show cause notice, and even CIT will issue show cause notice. What is the timing? What is the timing of issue of show cause notice? Now, that is also extremely important. The timing of issue of show cause notice is very, very, very critical. Sir, what is the timing of issue of show cause notice? The timing of issue of show cause notice is the AO will issue show cause notice before completion of the assessment proceeding. Before passing the order of the assessment, the AO has to issue the show cause notice. Similarly, the CIT appeal and the CIT also have to issue the show cause notice before completion of their respective proceeding. The CIT appeal will issue show cause notice before passing the appeal order and revisionary order. CIT will issue the show cause notice before passing the revisionary order under 263. And therefore, the timing is very important. Before completing the respective proceeding, they have to issue the show cause notice. One more thing, the Supreme Court held in the case of Shadi Ram Balmukund that the person who has found the escaped income can only impose the penalty. For example, if the escaped income is found by AO, then the penalty cannot be imposed by CIT appeal, and vice versa. If the escaped income is found by CIT appeal, then the AO cannot impose penalty on that item. So if AO has found the escaped income, AO has to issue the show cause notice and AO has to impose the penalty. That is what this particular judgment has to say. Sir, are we supposed to do this in all the cases? No, no, no. In all the penalties, you are not supposed to do this. You are supposed to do this only in case of what? The penalty under 270A. For certain other general penalties like penalty for not conducting tax audit, penalty for not maintaining books of accounts, you can initiate the penalty proceedings even if the assessment is what? Not made on the assessee. You can do that in that case also. Sir, what is penalty is also a proceeding? Yes, penalty is also a proceeding. The way assessment is a proceeding, appeal is a proceeding, rectification is a proceeding, revisionary is a proceeding. The same way penalty is also a proceeding, and penalty is also completed by passing a separate order, penalty order. And if you are not satisfied with the penalty order, you can file an appeal against the penalty order also. Okay. Now, how much penalty will be imposed and how to compute the penalty? Now, this is the most important part of this topic, and there are various cases in this which we need to understand one by one. Always remember there are three steps in computing the penalty. First step is to find out the underreported income. Second step is to find out the tax on underreported income, and the third step is to find out what the penalty on that particular underreported income. So first step is underreported income, second step is tax on underreported income, and then we have to compute penalty on that underreported tax. That is, in some cases it is 50% of tax, and in some cases it is 200% of tax. That you will come to know in the next 10-15 minutes. Okay, now let's see the first case. There are a lot of cases which I have put it in the boxes over here. The first case is over here. The return has been filed. Yes, return has been filed and the assessment has been done, and the income assessed is say 25 lakhs, and the income determined, that is income processed under the intimation, is 10 lakhs. So if the return is filed for the first time and your assessment is also done for the first time, and if your assessed income is greater than your income determined, then you will fall under this particular case. The first step is, step number 1 is to find out the underreported income. Underreported income is nothing but income assessed. How much is income assessed? 25 lakhs minus income processed. How much is income processed? 10 lakhs. So the difference between the two is 15 lakh rupees. So this is your underreported income. Now don't make a mistake of computing tax on this. Never ever compute tax on 15 lakhs. Computation of tax is a separate formula. So first step is over. Let's move on to the second step. What is the second step? Tax on something plus something. Then there is a bracket close. Then there is a minus. Then there is a tax on something. So what is that? Then the law says that first compute tax on something plus something. That is tax on underreported income plus income process. That is first compute tax on 25 lakhs. Compute tax on 25 lakhs. Then minus compute tax on what? Compute tax on 10 lakhs. Check. So first compute tax on what? Your 25 lakhs, and then compute tax on what? On your 10 lakhs, and then take the difference between the two. Is it clear? This is how you are supposed to compute the income. So first step, when you will fall under this box, when the return is filed for the first time, the assessment made for the first time, and your income assessed is more than the income processed, the difference between the two is your underreported income. So first you compute the tax on your total income, and then you minus the tax on your income processed. Okay, check it over here. Second case. What is the second case? No return has been filed. If the return is not filed, or the return has been filed under 148 and the assessment made for the first time, if the income, suppose there is no return filed, then how the assessment will be done? The assessment will be done under 144. So in that case, suppose the income assessed is 10 lakh and if it is greater than the maximum amount not chargeable to tax. What is the maximum amount not chargeable to tax? In case of individual HUF, it is, in case of individual, it is 2.5, 3 lakhs or 5 lakhs. In case of company, it is 0 rupees, because for company, firm, LLP, every rupees is subject to tax. Therefore, in case of individual HUF, the underreported income will be nothing but 10 lakhs minus the basic exemption limit. So this will become 7.5 lakhs for individual HUF, minus 3 lakh also, minus 5 lakh also, depending upon the age of the assessee. And in case of other than individual HUF, the entire income of 10 lakh is what is considered to be underreported, because for company there is no basic exemption limit, for firm, LLP, there is no basic exemption limit. So the entire 10 lakh will be considered as what? As their assessed income. Now how to compute this is the first step, that computation of what? Computation of underreported income. So if the return is not filed and assessment is done for the first time, whatever income is assessed minus the basic exemption limit will become what? Your underreported income. So in case of individual HUF, the underreported income is 7.5 lakhs. In case of others, the underreported income will be obviously the entire amount. Okay. Now how to compute the tax? Again, don't make a mistake. In case of individual HUF, don't compute tax on 7.5 lakhs. While computing the tax, you have to compute tax on 7.5 lakhs plus the basic exemption limit. In short, you have to compute tax on entire 10 lakh rupees, and then you have to compute the penalty of 50% or 200%. In some cases 50%, in some cases 200%. That I'll let you know in some time. Similarly, in case of this, there is no harm. In case of company LLP, it is directly. You can directly compute what? You can directly compute tax at what? 10 lakh rupees. So when you are computing in case of individual HUF, don't compute tax on 7.5 lakhs. You have to compute tax on 10 lakhs in both the cases. In case of individual HUF, 7.5 plus basic exemption limit, and in case of others, directly on 10 lakhs. Be very careful. Now, yours is a case of reassessment. Earlier assessment was done, and in the earlier assessment, your assessed income was 10 lakh. Now income is reassessed under 147. So now the income is 15 lakhs. So the difference between the two will be called as underreported income. Similarly, while computing the tax, first you will compute tax on 15 lakhs. First you will compute tax on 15 lakhs. Then minus you will compute tax on what? You will compute tax on 10 lakh check. So the difference between the two is 5 lakhs. So first you will compute tax on what? First you will compute tax on 15 lakhs. How, sir? Tax on underreported income plus income previously assessed. So first compute tax on 15 lakhs and then you compute what? Tax on income assessed earlier on 10 lakhs. Is it clear? I hope it is clear. So this is the third case where it is a case of reassessment. 115 JB case I'll address after some time. I'll come to the fourth case where the return income is a loss. Return income is a loss. When you file the return income was 10 lakh loss. But later on the loss was reduced. In case of 143 assessment, the loss was reduced to minus 2 lakhs, or the loss was reduced to plus 2 lakhs. Plus 2 lakhs. Anything can happen. Then the difference between the two, this minus this, will become your underreported income. Okay. That is minus 10 minus 8 will come to 8 lakh rupees. 8 lakh positive. Minus 10 minus of minus 2 will come to 8 lakh rupees positive. Right. So if your loss is reduced, or if your loss is reduced to some extent that it has become positive, then the difference between the two will be considered as what? Underreported income. Now in case of loss, always remember, it's very simple. In case of loss, directly compute tax. Assume that this 8 lakh itself is the total income. You don't have to do that tax on something plus something minus. That should not be done in case of loss cases. In case of loss cases, directly compute the tax. Check. Directly compute tax on 8 lakhs. Is it clear? Is it clear? Similarly, here also in case of reassessment, earlier there was a loss and then the loss was reduced, or loss was reduced to some extent that it became positive. So the difference between the two, the loss assessed now and the loss previously assessed, will become your underreported income. And then on the underreported income, you are supposed to directly compute the tax. Don't have to do all those things, tax on something plus something, minus tax on something. All those things should not be done. Directly compute tax on what? Tax on the underreported income, and that will become your answer. Is it clear? Now coming to the big one, how to compute penalty in case of 115 JB and 115 JC cases. That is in case of MAT. In case of MAT, how to compute tax. So in case of MAT, the underreported income is made in a special form. That is A minus B plus C minus D. Where A minus B is for normal provision and C minus D is for 115 JB. Once you understand A minus B, you will automatically understand C minus D. So what is A? A is the total income assessed as per the general provision. Whatever is the general provision, total income as per that. What is B? B itself is a difference of two things. B itself is a difference of two things. B is total income assessed as per general provision. B starts with A only, minus underreported income. So whatever is the total income assessed, suppose your total income assessed as per the normal provision, your total income is 80 lakhs and your assessed income is what? 110 lakhs. So what is A? Total income assessed as per the general provision, it is 110 lakhs. Total income assessed as per the general provision, that is 110 lakhs, minus as reduced by underreported income. How much is the underreported income? 30 lakhs. So 110 lakhs minus 30 lakhs is how much? This is 80 lakhs. So A is 110 lakhs, B is 80 lakhs. Therefore, A minus B is what? A minus B is 30 lakh rupees. Is it clear ultimately? So A is your total income assessed as per the normal provision. B is this minus the underreported income. Underreported income is 30 lakhs. You have to reduce that. You will get what? A minus B. Similarly, C minus D is the same thing, which talks about what? C minus D is the same thing, which talks about the total income assessed as per 115 JB. C and D is total income assessed as per 115 JB minus the underreported income in 115 JB. And then you have to compute tax on A minus B and then tax on C minus D separately, for which we have done a lot of questions in the class, if you remember. Now, one last thing which is said, I cannot explain all these things in great detail without the help of examples. So you need to see some questions in the textbook, which we have done it in class. Okay. So if the underreported income in B and D are same, sometimes it may happen that the underreported income which is there in B and which is there in D is same. Then the law says that you have to ignore in D and you have to consider that underreported income in B. So it might happen there are some underreported income which is common in MAT also, which is common in normal provision also. So if it is common, then you have to ignore in D and you have to consider in B, because in B the tax rate is higher, in D the tax rate is lower, because in D the tax rate is 15% MAT, but in B the tax rate is 25 or 30%, which is for domestic company. So be very careful. Okay. So let's go ahead with the next part, and the next concept is the concept of intangible addition, which is a part of same section only, 270A only. It's a part of 270A only. The concept of intangible addition is what? Let me explain you. The concept of intangible addition is sometime what happens, the assessing officer will make a disallowance based on some presumptive reasons. For example, the AO will say that your GP is very less. The AO will say that you are showing a GP of 2% as compared to industry average, which is 20%. So I will add 18% back. So because he is adding 18% back, say that 18% amounts to say 200 lakhs. So he can make some such additions on the basis of what? Intangible reasons. He does not have any authentic reasons for that, but he will add back those things based on industry average. So industry average is 20%, so you should also show 20% as profit. Why the hell you are not showing 20% as profit? This is what the AO will raise the question as. So in case the AO raises such question, then you have to add back that much amount. And that addition is called as intangible addition. Intangible addition is nothing but a presumptive addition made by the assessing officer. Assessing officer does not have any proof and evidence against that. He does not have hardcore evidences against that. The question is, can assessing officer make such intangible additions? The Supreme Court in the case of Anantavira Singhai has held that yes, the AO has the right to make such intangible additions, and he will take taxes on you on that much amount. But the question is, can AO impose penalty on that much amount? The AO cannot impose penalty on the intangible addition. On intangible addition, AO cannot impose penalty. Be very careful. The AO can only take taxes on the intangible addition. He cannot take penalty on that intangible addition. So, for example, today the AO has made an addition of 200 lakhs in the form of intangible addition. Will he take taxes from you today? Yes, he will take taxes from you today, but he will not take penalty from you, because the government says that penalty cannot be imposed because nobody knows that exact reason why this has been added. This is just added on the basis of what? Presumptive reason. Now suppose after 40-50 days the AO finds some jewelry at your place, or some money at your place, some unexplained money, some unexplained jewelry, some unexplained investments, and then you start to explain that this unexplained money, unexplained bullion, unexplained jewelry is from that intangible asset. Now if you start to explain that it is from that intangible asset, the AO says that, the government says that, the Supreme Court says that, at that time you can impose penalty on that amount. So you can impose penalty on that amount in the year in which the assessee start to explain that this intangible additions is out of this unexplained investment is out of that intangible additions. So by default, I'll just give you a synopsis once again. The AO has the right to make an intangible addition. So when he make an intangible addition, he will take tax. He will not impose penalty. But later on, if something is found as unexplained money in your hands, and if you say that this unexplained money is coming from that intangible additions which you have made earlier, then the AO will impose penalty under 270A4 and 270A5. That is what it is written over here. Next. 270A subsection 6 says that the assessing officer, the CIT or CIT appeal has to give what? Has to give an opportunity of being heard by giving a show cause notice to the assessee. Now, if the assessee gives a bona fide explanation, then the penalty proceedings have to be what? Dropped. No penalty proceeding should be imposed on the assessee. Obviously, if you are giving an opportunity to other person, and if the other person explains everything well and good, then obviously you have to drop the proceeding. You cannot impose penalty in that case. Okay. Next. By default, there are two cases of penalties over here. One is 50%, one is 200%. So by default, if nothing is mentioned, you can take 50%. But if your underreporting is an account of misreporting, if it is account of what? Misreporting. If it is a case of misreporting, then the department says that then the AO can impose, the CIT or CIT appeal can impose 200% penalty on you. And therefore the question will arise, what do I mean by the term misreporting? Misreporting means some kind of thief. You are trying to thief something. You are trying to chorify something. You are trying to do some chori over here. Okay, some kind of chori is done by you, some kind of theft is done by you. That is known as what? That is known as misreporting. But the government has explained that what all includes in the definition of misreporting. First one, misrepresentation or suppression of facts. You are doing some misrepresentation or suppression of facts, that can be called as what? As your misreporting income. You are failing to record an investment in the books of accounts. You are claiming an expenditure which is not substantiated by an evidence. Means you are claiming an expenditure but there is no evidence behind it. There is no proof of that expenditure. You are recording false entry. You are not recording your revenues revenues in the books of accounts, you are not recording your sales in the books of accounts, or you are failing to record your international transaction, deemed international transaction, or specified domestic transaction, which we'll talk about in detail in the chapter of what transfer pricing later on. Okay, one last thing is there under this particular section, and that is 270A11, which says that suppose if you are found with a property of say 1 crore rupees, or with an unexplained investment of 1 crore rupees. Now the AO has put a penalty of 200% on you, and you have paid that penalty also of 200%. Now will the AO impose penalty of 200% again in the next year by saying that no, it was unexplained, it was unexplained? No, no, no. Once the property is unexplained on which you have already paid a penalty of 200%, now that property can be disclosed without any hesitations, and the AO will not be allowed to impose penalty on that same property again and again every year. Otherwise it doesn't make sense of disclosing the property in front of the officer. Okay, so this is what this section is all about. 270A, a very, very, very important section for your exam, one of the most important section of this topic. Now the next part is there any way that I can get immunity from the penalty under 270A or a prosecution under income tax law? So what shall I do if I want some immunity from penalty and prosecution under the income tax law, especially if I want immunity from penalty under 270A? You have to follow a lot of procedures. First step, you have to make an application to the assessing officer within 1 month from the end of the month in which the order of assessment is received. So whenever is the order of assessment received, you have to make an application to the assessing officer. Plus, you have to pay the demand within 30 days along with the interest. You have to pay the demand within 30 days along with the interest. Third, you should not file an appeal against the order of 143 or 147. You should not file an appeal. So first, make an application to the AO within 1 month, pay the demand, pay the interest, pay the tax within 30 days, and do not file an appeal. Then the AO will pass an order within 1 month accepting or rejecting your application. AO may accept your application, AO may reject your application. If AO rejected your application under 270AA, then you cannot file an appeal or revision against this order. This order of 270AA is not appealable, but you have got the power. You have got the power to now appeal what? Your original assessment. Now you can appeal what? Now you can appeal this order under 143 and 147. Be very careful. When the AO will pass an order, he can do either accept your order and he will waive your penalty, or he can reject your order and he will not waive your penalty. In case he reject your order, then you cannot file an appeal against this order, but you can go to the original order and file an appeal against what? The original assessment order 143, 147. You will get extra time also to file an appeal. You will get an extra time to file an appeal. And last but not least, where it is admitted, where the appeal is, where your order is admitted, it means your penalty is waived, then the assessee cannot file an appeal or rectification or revision application against the order of assessment. Then the assessee cannot file an appeal against the original order. Assessee cannot file a revision application against the original order. So the rule is very simple. You have to make an application to the AO within 1 month. You have to pay tax, you have to pay interest within 30 days, and then you have to not appeal against the original assessment order. Then you have to wait for the decision of the AO. If AO reject, then you cannot file an appeal against this order, but you can file an appeal against the original order of assessment which you are not filing at the beginning, and then you will get extra time to file an appeal. If the AO accepted your order, then that's the best thing. That is the reason why you have gone to the AO under 270AA. If he accepts your order, then nothing better than that. If he accepts your order, then he will what? He will waive your penalty, he will waive your prosecution, and in that case, then also you cannot go and appeal against the original assessment order. Now be very careful. He will only waive your penalty of normal cases, that is 50% cases. He will not waive your penalty under this section of 200% cases. Misreporting cases cannot be waived by AO. Under this section, AO does not have the power to waive your penalty of misreporting. He only has the power to waive your penalty of underreporting. Okay. So let's talk about this next provision, which is special penalty provision for search and seizure cases. Now in this provision, you need to first of all understand two very important terms. One is specified previous year and second is specified date. So in specified previous year, there are 2 points. What do I mean by the 2 points? The first point, there are 2 specified previous year which can be possible. First, a year which is prior to the year of search, for which the due date of filing of return under 139 has not expired and you have also not filed the return of income. If these 3 conditions are fulfilled, then the last year can be considered as specified previous year. Last year, suppose this year search has happened. Suppose search has happened in the month of July. So in the month of July 2022, search has happened. So 21-22 can be considered as a specified previous year if it is a last year. Secondly, the due date of filing of return has not expired in the month of July and you have also not filed the return. If these 3 conditions are fulfilled, then it can be considered, last year can be considered as a specified previous year. Current year will always be, that is the year of search will always be considered as a specified previous year. Now, what is specified date? For last year, the specified date will be the date which is mentioned under 148, because after search and seizure, you all know that after search and seizure is happened, after that a notice comes to you under section 148 whereby you have to file a return within the time specified in 148. So this point, for point number 1, the specified date will be the date which is mentioned in section 148. 153 is not relevant, it was relevant before 2021. And for point number 2, it is the due date under 139(1) which would be relevant for you for filing the return of income, that will become the specified date. So be very careful. The entire catch of this provision lies on these two terms. Specified previous year means what? As per point number 1, last year, that is the year prior to the year of search, for which the due date of filing of return has not expired and assessee has also not filed the return, and for that specified date will be the date which is mentioned under section 148 for filing the return of income. And second one is very simple, that is the year of search. Now suppose the search is going on and something is found at your property, some cash, some bullion, some money, some jewelry, etc. is found in your property. Then what will happen? Will the AO ask you a question or not? That you have to answer the question which is asked by the assessing officer. So the AO is asking you the question, from where the hell you have got this money, bullion, jewelry, etc. If you are able to explain, well and good, he will leave you. But if you are not able to explain, then you are not going to leave you. He is going to impose penalty. But here comes something in between, whereby this particular provision comes into picture, which says that if the assessee during the course of search means before the search is completed, before the search and seizure is completed, gives a statement in section 132 subsection 4 and explain the nature and source of that asset and explain that this asset belongs to the specified previous year. It belongs to specified previous year, that is either last year or either current year, and he pays the tax, he pays the interest, and he also files the income tax return on or before the specified date. So what is he supposed to do? Listen carefully. Whatever money, bullion, jewelry, etc. is found during the course of search, if you explain that this money, bullion, jewelry belongs to specified previous year, that is last year or current year, and in that case also he has to explain before the search ends, that is within a span of 1 or 2 days. Search generally conducts for 1 or 2 days, so it has to be explained within a span of 1 or 2 days in a statement under section 3132 subsection 4, and he has to pay the tax, he has to pay the interest on or before the specified date, whatever is the specified date above. In that case, he will be imposed with a penalty of 30% of undisclosed income. We are not going to leave you, still we are going to impose a penalty of 30% of undisclosed income. But if you do not fulfill any of the conditions which I just mentioned, then you will be imposed with a penalty of 60%. If you fulfill these conditions, the penalty will be 30%, slightly lower penalty. If you do not fulfill any of the conditions, then the penalty will be 60% of undisclosed income. Plus one more, Finance Act 2022 amendment has been made over here. Earlier, this penalty was imposed only by AO, but now this penalty is also imposed by what? CIT appeal also, along with the assessing officer. Now even CIT appeal can impose this penalty on the assessee. Check it please. Okay, let's go ahead. Can the department impose penalty on chartered accountant? Can the department impose penalty on merchant banker? Can the department impose penalty on registered valuer if they make wrong reporting, wrong certification? Yes, the department can impose penalty. The AO or CIT appeal can impose penalty of rupees 10,000 for every such report or certificate. For every such wrong report, for every such wrong certificate, they will impose a penalty on these three people of rupees 10,000, and reasonable opportunity of being heard will be given before the penalty is imposed. Reasonable opportunity means opportunity of being heard will be given to the assessee, that is to these three people, before imposing the penalty. Next, the procedure for imposing the penalty. Before passing the final order, before passing the penalty order, the respective authority has to give an opportunity of being heard to the respective assessee. Before passing the penalty order, opportunity of being heard must be given to the assessee. And secondly, if the penalty is more than 10,000 imposed by the income tax officer and more than 20,000 imposed by assistant commissioner or deputy commissioner, ITO is imposing more than 10,000 and assistant commissioner, deputy commissioner imposing more than 20,000, then both of them have to take an approval from joint commissioner. Without taking an approval from joint commissioner, they cannot impose the penalty under any provisions of the income tax law. Further, the penalty proceedings are also going to be faceless now, as it is already been notified by the government of India, but it is not there in your syllabus, in your study material. Okay, let's go to the next penalty, that is 271 AAD, penalty for fake invoice. If at any proceeding it is found in the books of accounts, if the proceeding is pending, the proceeding is going on, and if it is found in the books of accounts by AO or CIT appeal that you have passed a false entry, or you have omitted a correct entry, to evade tax liability. Now always remember, passing a false entry is also wrong, deleting a correct entry is also wrong. Both of them are wrong. Then the AO or CIT appeal will impose a penalty equivalent to the sum of the false or omitted entry. Suppose you have passed a false entry of 1 lakh rupees, then the penalty of 1 lakh rupees will be imposed. Or if the assessee has omitted an entry of 1 lakh rupees, then the penalty of 1 lakh rupees will be imposed. Secondly, if somebody else provoke you, suppose the chartered accountant or accountant provokes you, the pass the entry, I will see, pass false entry, pass fake entry, omit correct entry, I will deal with the department. Then in that case, the penalty will also be imposed on the chartered accountant, etc. The chartered accountants will also be subject to penalty. The accountant will also be subject to penalty, or any other person who has provoked you, who has told you to pass such entry or delete such entry, will also be liable for what? Penalty by AO or CIT appeal equivalent to the amount of entry deleted or the amount of entry passed. Okay. Now, what do I mean by the term false entry? False entry means what? False entry means any entry on which there is a false document, false documents or false document. You are passing an entry with a false document or a false document, or you are invoicing a person. Okay, you are invoicing a person. You are passing an entry without actual supply to any person. So you are showing that I have purchased from Ratan Tata, I have purchased from Reliance Industry, I have purchased from Infosys, I have purchased from Wipro, but you have not actually purchased anything. You are making a false entry. And the third one, you are passing an entry in the name of a person who does not exist only in this world. Suppose you are passing an entry that I have purchased this much from XYZ Limited. There is nothing like XYZ Limited in this world. So that is also a false entry. So any entry made on false documents or any entry made on a document without actual purchase of that particular transaction, or any entry made with a document whereby the other person does not exist only, all of them can be considered as what? As a false entry. Now let's talk about the next section, which is extremely important, power of the CIT to reduce the penalty in certain cases. There are two sections over here. One is 273A subsection 1, one is 273A subsection 4. First, I'll talk about the distinction between the two, then I'll talk about the similarity between the two. In the first section, the CIT can only reduce the penalty under 271A, 271(1)(c) or 270A. Now 271(1)(c) is now no more relevant, only 270A is relevant. So in the first section, the CIT can only reduce 270A, but in the second section, CIT can reduce any penalty including the penalty of 270A. So the second section is broader as compared to the first section. In the first section, CIT can suo motu also reduce your penalty. You can also make an application. In the second section, only you have to make application. CIT suo motu will not reduce the penalty. In the third section, the CIT has to take an approval from Chief CIT or Director General if the concealed income exceeds 5 lakh rupees. So if the concealed income exceeds 5 lakh rupees, then he has to take an approval from higher authority. But in the right hand side, if the penalty exceed 1 lakh rupees, then he has to take an approval from Chief CIT or Director General. Be very careful. On the left hand side, in the first section, the CIT has to fulfill, the assessee has to fulfill, certain conditions. The assessee has to fulfill that he has cooperated, he has given necessary cooperation to the department, and he has paid taxes and interest properly, and he has made true and full disclosure honestly. On the right hand side, the assessee has to prove that there is a genuine hardship. Genuine hardship means genuine financial hardship on the assessee, and assessee has provided necessary cooperation to the department. In the next one, in the first section, if the penalty is paid, it can also be refunded if it is waived. If you have already paid the penalty, the department can refund also, but in the second section, refund is not possible. If you have paid, then the penalty cannot be waived in the second section. In the first section, the CIT will pass an order without any time limit. Whenever the CIT wants to pass an order, CIT can pass an order. There is no time limit. In the second section, CIT will pass an order within 12 months from the end of the month in which the application is received by the CIT. So there is a time limit. There is a time bound on the CIT to pass an order. In the first section, there is no time limit in the hands of CIT. Now, in both the sections, you have to go to the department to waive the penalty only once in a lifetime. Once a penalty is waived in your favor, then you cannot go again for waivers for the second time in your life. So one person, only one time in favor. You cannot get the benefit of this waiver again and again subsequently. Once you get the favor, second time you cannot go. The doors are closed under this section. You can go some other section, but you are not allowed to come. You are not allowed to come to this section. Next, once an order is passed under 273A, no appeal is possible against this section. This is the second order against which appeal is not possible. Earlier, section 264 was also the order against which appeal was not possible. Now this is the second order against which appeal is not possible. You can file a writ petition. Next, the order under 273A should be a speaking order. Speaking order means it should give details about how the penalty are waived, how the penalty are not waived, why penalty is not completely waived, or why penalty is waived only 50%. They have to tell everything in detail. They cannot just write everything just randomly and then tell that we don't want to reduce the penalty or we are not going to reduce the penalty. They have to tell you the reason for not reducing the penalty or reducing the penalty to a particular percentage. Okay. Can assessee make an application for number of years? Yes, assessee can make an application for number of years. No harm in that. Assessee can make application for 1 year, 2 year, 3 year, 4 year, 5 year, 6 years, as many years as the assessee wants to make it. Next, can the department waive penalty if the income is found out in search and seizure? No. If an income is found out in search and seizure, then the penalty under this section cannot be waived. 273A1 is also not possible. 273A4 is not possible. Now, next provision is only for 273A4. 273A4 says what? There has to be genuine hardship. So genuine hardship should be when? So department says that, next provision is also for both the sections. If the assessee is satisfied all the condition, then the CIT is bound to give relief under 273A. The provision, this is the CBDT circular which says that if the assessee has satisfied all the conditions mentioned in section 273A1 or mentioned in section 273A4, then the CIT is bound to give the relief under 273A. Next, can CIT reduce your interest under 234ABC? CIT does not have the power to reduce interest under 234ABC. That power is given to Chief Commissioner or Director General of Income Tax. That that power is not given to the CIT. Next one is again a CBDT circular, but only in respect of 273A4, which talks about genuine hardship. So the CBDT has said that genuine hardship should exist both at the time on which the application is made by the SSE and at the time on which the order is passed by the CIT. So genuine hardship should exist both at the time of application and also at the time of passing of order by the CIT. Can an SSE make multiple application? Now this point is a repetition of what we have done earlier. So if the SSE is making multiple application on different dates, so today I'm making application for 15-16, tomorrow I'm making application for 16-17, day after tomorrow I'm making application for 17-18, then 18-19, then 19-20, then the CIT is supposed to consider all the application and he will pass one single order considering all the application on the merits. Last but not least, once the penalty is waived, will prosecutions will also be dropped? Yes, the department says that once the penalty is waived, the department will also waive your what prosecution proceedings under the income tax law. Otherwise it doesn't make sense. They are waiving your penalty and they are putting you in jail. What sense does it make? An SSE will say that won't put me in jail, take the penalty instead. That would be much better for me. So therefore, if the penalty is waived, then the prosecution proceedings will also be waived on you. Now there are certain unexplained sections which we need to understand, like 68, 69, 69A, 69B, 69C, 69D, and then the master section 115BBE, and then the penalty section for this master section 271 AAC. All these 8 sections go together hand in hand. Now what is section 68? Section 68 talks about cash credit. It talks about if there is some cash credit found in your balance sheet, in your books of accounts, and if you are not able to explain, or if your explanation is not satisfactory, then it is deemed to be income, deemed to be income, deemed to be income. For closely held company, the provision is further stricter. If I am a closely held company, then I have one more responsibility, that if I am a closely held company and if I receive money from my resident shareholders, then I have to explain the source of income in the hands of my shareholder also. I have to explain from where the hell my shareholders have got the money. I have to explain that also, that from where the hell my resident shareholders have got the money. If I'm not able to explain that, then in the hands of the closely held company, it is a deemed income. Now further an amendment is made by Finance Act 2022, which says that now this provision is applicable to everyone, closely held company, normal company. If you have taken a loan from some person or some credit for some person, then you have to also explain that whether the loan is received, whether the loan, who is giving the loan, who is giving you the loan, from where the hell that person has got the money. Suppose one of my friend Mr. X is giving me a loan of 10 lakh rupees. So now I have to also explain that from where my friend Mr. X has got this 10 lakh rupees. If I am not able to explain the source in the hands of my friends of that loan which he is giving to me, then also it will be deemed income in my hands. Check it this over. This is the amendment made by Finance Act 2022. So if a person is giving you some credit, you have to explain from where the hell he has got the money to give you the credit, or else you will be liable for section 68, and what are the consequences you will come to know in a while. Now this provision is not applicable to a venture capital fund or venture capital company. This provision is not applicable to a venture capital fund or venture capital company. They have been relaxed. Next, 69. If you have made some investments and which are not recorded in the books of accounts, you have made some investment, you have bought some properties, you have bought some fixed assets, shares and securities, but it is not recorded in the books of accounts, and the explanation given by you is not satisfactory, or you are not able to give the explanation, it is deemed to be income in your hand. And what will happen, you will come to know in a while. Unexplained money, you are found to be in possession of unexplained money, unexplained bullion, unexplained jewelry, etc. It is deemed to be income in your hand. You are found to be in possession of investments which you are not fully recording. You are buying a jewelry of 5 lakh rupees but showing in the books of accounts only 2 lakh rupees. You are buying investments of 10 lakh rupees but showing in the books of accounts only 6 lakh rupees. So the differential amount which you are not showing, which you are hiding, will be deemed to be income in the hands of the SSE. And what will happen, you will come to know in a while. And when you incur an expenditure but you are not able to explain the source of that expenditure, you have done a 1 crore rupees expenditure on the wedding of your daughter, but when the income tax department asks you from where the hell you have got the money to incur the money on your daughter's wedding, you are not able to explain the source, then the department will say it is an unexplained expenditure, we are going to take some dangerous tax, Draculian tax from you. Similarly, if you incur some expenditure in your business or profession or for any other purpose, and that expenditure which you have incurred is from an unexplained source, then that expenditure deduction will also be disallowed under the income tax law. It will not be allowed as a deduction. So if you incur an expense from an unexplained source, that expenditure will also be what? Disallowed, disallowed and disallowed. And last but not least, if you borrow the money on hundi, or if you repay the money on hundi, then you have to borrow the money on hundi by account pay check, and you also have to repay by account pay check. Suppose if I borrow the money on hundi by cash, then that it will be deemed income. Now when I repay also in cash, so now the deemed income will not be twice, it will be only once. So once you borrow, at that time if you have paid the penalty, so again if you have paid the tax, so again while repaying, even if you make the payment by cash, it is allowed. You will not be charged tax twice on borrowing and payment as well. Okay, next thing. In all these cases, what is the penalty, what is the tax which is charged? The tax is 78% tax. 60% tax, 25% surcharge, 4% cess is chargeable in all these cases. Plus, you will be liable for no deduction under any provision of the income tax law. All these incomes from 68 to 69D will be directly chargeable at 78% without deduction of any expense, any allowance, any set off of loss, nothing would be allowed. Further, you will also be liable for a penalty which will be imposed by AO or CIT appeal under 271 AAC, but this penalty will not be imposed on assessees covered under 271 AAB. For assessees who are covered under 271 AAB, that is search and seizure cases, for them the penalty will be imposed as per 271 AAB only. But apart from that, apart from 271 AAB, whatever tax you have paid under this section, we will also be taking 10% penalty on that tax amount. Now, if you want to get escapement from this tax, you have to follow the following conditions. Whatever income, undisclosed income is there, you have to pay the tax before the year ends, and you have to disclose that income under 139(1) ROI. Then you will be escaped from this particular penalty. You can check it. So by default, you have to pay 10% tax, 10% of the tax as your penalty. But if you want to escape, you have to pay the tax by 31st of March of that particular financial year, and you have to file the return by the due date of filing of return, and you have to include that income as a part of your return. Then you will be escaped from this particular penalty of 271 AAC. Okay. Now let's talk about the next section, that is 269 SS, which talks about you should not accept any loan, deposit or any specified sum by other than the foremost. You should not accept any loan, deposit or sum by bearer check or cross check or cash. You should accept by account pay check, account pay draft, ECS or such other electronic mode. Of how much? Listen carefully. Now there are three clauses. Should not accept any loan from any person, that is any cash loan of 20,000 or more. If you take, there will be a penalty or equivalent to the loan accepted under section 271D, which will be imposed by the joint commissioner. It is the joint commissioner who is going to impose the penalty on you. Second, on the date. So the first clause talks about very simple thing. If you are taking any cash loan from anyone of 20,000 rupees or more, you have to accept by four modes. Apart from that, if you take cash loan, bearer loan, cross check loan, it will be subject to penalty of that much amount. Second point, on the date of taking such cash loan, if you are taking a cash loan, and if you are already having an outstanding loan of 20,000 rupees or more, then also you are liable for penalty. For example, you already have taken a loan of 25,000 from Mr. A. Now, even if you take 1,000 rupees in cash or even 100 rupees in cash, you will be trapped in point number B check. So point number B says that on the date of taking the cash loan, your outstanding amount earlier should not be 20,000 or more. If your outstanding amount is already 20,000 or more, you cannot accept a single rupee in cash. And point number C says what? Point number C says what? The addition of these two, that is point number A, the cash loan along with the outstanding on the date of cash loan. If that is also 20,000 or more, then also you are trapped. So point number A is very clear. You should not accept cash loan of 20,000 or more. Point number B is very clear. If there is already a 20,000 outstanding, you should not accept a single penny in cash. Point number C is very clear. Cash loan along with the cash loan on the date on which 20,000 was outstanding. Both of them taking together should also not exceed 20,000 or more. If either of the three things are happening, you will be liable for penalty under 271D, and the AO, that is the joint commissioner, will impose the penalty over here. Now, there is one specified sum word used over here. What do I mean by the term specified sum? Specified sum is defined in the law over here. Specified sum means you should not take any advance from anybody in respect of an immobile property. Suppose you are planning to sell your immobile property, so you have taken an advance from someone. That advance should not be accepted in cash, should not be accepted in bearer check. That advance should also be accepted by account pay check, account pay draft, ECS and such other electronic mode, the four golden modes which are mentioned by the law again and again in different provisions. Next. Now, this section is not applicable to certain people. If the loan is accepted by government, this section is not applicable. If the loan is accepted by bank or post office or cooperative bank or corporation established by central, state or provincial act, or if it is established, if it is accepted by loan is accepted by a government company, then these provisions are not applicable to these people. Further, this provision is not applicable in one more case. If the lender and the borrower both are agriculturist, if I am also agriculturist, you are also agriculturist, my income is also less than basic exemption limit, that is taxable income is less than basic exemption limit, and your taxable income is also less than basic exemption limit, then there is no harm. This section is not applicable for us. We both should be agriculturists, we both should be farmers, both of our income should be less than the basic exemption limit, then I can accept the money in cash. Check it please. Similarly, there is an opposite of this section. Once I borrow, the borrowing of money in cash is not allowed. It is prohibited. Similarly, repayment of money in cash is also not allowed as per 269T. Now, while repaying, though, you also have to check that when you are repaying, you also have to check the interest portion. Suppose you have borrowed a cash of 18,000 rupees from someone. No 269 SS will be attracted. Now, while repaying, you are repaying 21,000. Why? 18,000 principal I am repaying and 3,000 rupees interest. 269T will be attracted because while repaying, you have to check what? You have to check both the amount. That is principal along with the interest. Check it please. Principal along with the interest should not be 20,000 or more. And here, while repaying, to even bank cannot repay you the money in cash. You can give the money to bank in cash, but bank cannot repay you the money in cash. For example, you gave 1 lakh rupees to bank because you want to make an FD. So you give cash to bank. Now bank cannot repay you when the maturity of the FD will come. Bank cannot repay you that FD in cash. That is not allowed. Bank will be liable for 269T. Check it, please. Similarly, here also, if I have taken a loan of 1 lakh rupees from you, now if there is an outstanding of 20,000 or more in my books of accounts in your name, if there is an outstanding of 20,000 or more in my books of account, then I cannot repay a single penny in cash to you. I am not allowed to repay cash to you the way it was in the 269 SS. So if you have given me a loan of 1 lakh rupees, now I cannot, because there's already an outstanding of 20,000 or more in my books of account. Now I cannot repay a single penny in cash. This is what point number B has to say. And point number C is the same point which we have seen in the 269 SS also. Like there was a term called as specified advance. Similarly, here it is written specified advance is mentioned here also. You cannot give advance to any person in cash. If you give advance to any person in cash, you will be liable for 269T. Similarly, this section is also not applicable to certain people. Who are those lucky people to whom this section is not applicable? Nothing contained in 269T shall apply to repayment of any loan or deposit or specified sum or accepted taken from. So if you take a loan from government, you can repay to the government in cash. You can repay to the bank in cash. You can repay to the post office in cash. You can repay to the commercial cooperative bank in cash. You can repay to them in cash. You can repay to government company in cash. But they cannot. Bank. So here you will have a confusion. Sir, here you are saying this section is not applicable for banking company, and here you are saying this section is applicable. There is a difference. You can repay to bank in cash, but bank cannot repay to you in cash. You can repay to bank in cash. Bank cannot repay to you in cash. This is the difference between the two. You can read the provision very carefully. Here also, if you repay in cash, the Joint Commission will impose penalty under 271E equivalent to the cash loan repaid. Okay, the equivalent to the cash loan repaid. So, will the penalty be imposed on interest portion also? No. Interest portion penalty will not be imposed. The penalty will only be imposed on the loan portion, not on the interest portion. So if you are repaying 18,000 rupees loan and 3,000 rupees interest, all of them in cash, penalty will only be 18,000 and not 21,000. Okay. Now this is the circular which I have said you earlier also, that the penalty under this section, that is 269 SS and 269T, will be imposed by the Joint Commissioner and Joint Commissioner only. It cannot be imposed by anybody else except Joint Commissioner. Joint Commissioner has to impose the penalty. This is what this provision has to say. Okay. Next, section 129, change of incumbent of an office. Now what do I mean by change of incumbent of an office? This provision talks about, suppose your assessment is done by Mr. X, an assessing officer. Now suddenly after 3-4 months, the assessing officer Mr. X gets transferred to some other place. So new assessing officer Mr. Y came into picture. So if the new assessing officer is coming into the picture, he has to continue the matter from where the previous officer has left. So previous officer has checked 2-3 items, he has to go ahead with the rest of the items. But the assessee has the power to tell the new officer that whatever the previous officer has checked, you please recheck that. So if the assessee requests that, then the new officer has to recheck all the items which has been checked by the previous assessing officer. So this is the right which is given in section 129. By default, if an officer leaves in between, the new officer will continue the job from there itself. But if the assessee requests that please see the old matter also which was seen by the earlier officer, then in that case the department has to see the old matter also. This is what this section 129 has to say. Next, 272A, if the assessee fails to answer certain question, fails to sign certain statement, fails to furnish certain information, fails to file certain income tax returns, statements, allows inspection, then the penalty of 500 rupees for every day will be imposed on the assessee. This is an amendment made by Finance Act 2022. Earlier this penalty was 100 rupees per day, but now it has been 500 rupees per day. I have also made the changes in the chapter of income tax return, special assessees return. Do you remember that? So this is what I was talking about. Last but not least, after this I will stop today's session. I have put some illustrative list over here. What are the major functions of CIT and principal CIT? The major functions of CIT and principal CIT is to supervise the assessing officer, is to make revision under 263 and 264, is to approve charitable trust, that we'll see later on, is to reduce or view penalty, that we have seen just in today's lecture, is to grant approval for certain notice and direction, that we have seen in section 147, is to approve provident fund, gratuity fund, that we'll see in the chapter of TDS, is to reduce interest under 220, that we have seen in this chapter itself while we are doing the assessee in default in this revision video itself, not in this chapter. In the chapter of appeal we have seen that. What are the major functions of chief CIT and principal CIT? The principal CIT and chief CIT will supervise the CIT and the CIT appeal under them. They will also waive interest under 234A, 234B, 234C, and rest of the 4 powers are same as the power which has given to the commissioner and the principal commissioner, as you can see over here. So we have covered a good amount of chunk over here, and I can say almost our entire assessment procedure is now completed. So that's it from my side in this video. I'll try to upload the maximum videos for you all as early as possible, with great content, great comprehensiveness, with full English for all of you. Well, your duty is only once. You have to share these videos to maximum of your friends who are giving their exams in the coming attempt. Okay. So that's it from my side. Take care, all of you. If you want this book, you can order it from my website, that is aarishkhan.com. It is available on my website also in full color, okay, in the same form as you can see on the board. Take care, all of you. Bye.